European equities.
Of course, in terms of the numbers, like-for-like sales missed, but the core numbers seem to be in line. Some weakening of the US consumer. Volvo Trucks also interesting. Some weakness in the numbers there, but orders looked okay according to some of the analysts. Too soon, though, to assess tariff impact, and that seems to be a theme that we will come back to, Guy.
Absolutely. So here we go. We're going to find out. We're going to figure out exactly what these stocks, what these bourses, indices are going to do. Germany looks like it's going to be a big outperformer. It'll take a moment to get Germany open. So let's start with what is happening with the FTSE. It is climbing higher. We're up by around 0.2%. We're expecting it, once it's settled and everything is open, to be up circa 1%. Elsewhere, we're expecting a little bit more strength. The CAC 40 may be up by around 1.3, 1.4%. The Stock 600 is now up by 0.4%. I think you're going to see quite a big dispersion today in the individual stock story. So you can see SAP potentially up at one end, potentially up sort of 8, 9, 10%, is that's what we're looking at. But you're going to see other names, maybe some of the staples names. There could be quite significant dispersion there. We'll see what happens with these individual stock stories. It feels a bit more of a bottom-up story as we get into earnings season than it has been of late. The CAC is up by 1.1% this morning. Actually, now the FTSE 100 appears to be outperforming those two markets neck and neck. The IBEX is up by 1.34%, but it is the DAX that I am waiting for. It is SAP. I want to see how high this stock goes this morning, Anna.
Yes, okay. We are certainly waiting for that SAP number then. In terms of the sectors that we have on the move this morning, it's the banking sector that's at the top of the grid. Banking and basic resources sort of competing it out to be the best performing sectors this morning. So this is sort of risk on sense in markets, picking up from those comments around the tariffs in China won't be as high as they are right now, according to both Trump and Bessent. So that's positive for risk sentiment. And also the lines around the Fed chair and not removing him, that's positive for risk sentiment. In terms of the negative sectors, I just see one, and Reckitt Benckiser seems to be one of the victims there, down by 2.6% on the Reckitt Benckiser stock on the back of the numbers coming out. It's said that they've been described as mixed by some of the analysts. Well, clearly the negatives dominating, and it's the like-for-like sales that missed, and some weakness in the US consumer as well. I wonder if that's a line that weighs heavy on the stock this morning.
What I think is also interesting is the Reckitt is down, but you've also got some of the defence names down. Now, I wonder whether that's in reaction to some of the names that we've seen posting numbers out of the United States, or whether actually people just rotate out of what has done well recently and rotate back into maybe a more nuanced earnings story. So I think that'll be interesting, really interesting to watch. AP Møller Maersk is up really strongly this morning. That's a name that I think is worth paying attention to. In terms of where the points are being added, HSBC, ASML, Novo Nordisk bounced back quite strongly, Shell and Roche. It's a really mixed picture in terms of the overall performance that we're seeing out of Europe this morning. And I feel we're going to go into a less index-orientated, more single stock sort of story, which I think will be really interesting as the different messages begin to emerge. Have we got an SAP trade? We got
apparently so. Up
10%.
There we go. Up 10% on SAP. So it seems that the numbers came in better than expected. There is some resilience perhaps around some of these services businesses, given that one of the big threats right now is tariffs, and a big obsession this earnings season is going to be tariffs. So businesses that can step aside from that, at least in terms of direct impact. There's always the question of indirect impact, and we were discussing this with the Akzo Nobel CEO a little earlier on. So there we are. The DAX is up pretty strongly on the back of those SAP numbers. The DAX up 2.4% with strength coming from SAP. Joining us now to talk about the markets, Bernie Akong, Global Multi-Strategy Alpha CIO at UBS O'Connor. Bernie, very nice to have you with us. Interesting dynamic, interesting sentiment in markets, I suppose, today, yesterday and today, much more positive. key lines on China, key lines on the Federal Reserve coming through from the US administration. But they're kind of just writing other comments that the US administration had previously made. So looking through all of that volatility day to day, how risk-on are you feeling about global markets?
I think tactically in the near term, I'm feeling, a lot more constructive than I have been for a while. I think people got too bearish coming into Monday. And whilst, yes, I agree with, the consensus that there's lots of concerns over the coming quarters, I think the short-term positioning and sentiment has gone quite far. I think there was, for me, very little chance that Trump was ever going to really go down the path of firing Powell. I think we are going to get some trade deals, maybe not with China, but I think places like Japan and India are very credible and they want to do deals. So I think in the near term, there is a roadmap for more risk on, and particularly not just more dispersion, but you mentioned it just then, Guy. I think cycles versus defensives, they've underperformed a lot. There's scope for some, sort of relief rally and bounce here. And if you look underneath the surface, cycles are pricing in a lot of negative news now.
So is this because we made too much of the end of US exceptionalism idea and actually that was all overblown? Or is that idea still in place and this is just a sort of short-term risk relief rally?
I think it's more the idea is in place, but these things take time. Don't forget, a lot of the big pools of capital meet on a quarterly basis to make decisions. So what happens is these shorter term parts of capital do move very quickly, but if everyone moves in the same direction, the same door at the same time, you know what happens, right? We overextend, and that's what's happened here. I think it will continue over the coming quarters, but in the short term, it's just overextended. When you look at different indicators, they are at levels which suggest we have some sort of tactical relief rally.
Is any risk rally going to be sort of constrained by the fact that the risk management is probably on high alert at the moment? The risk managers are watching what is happening very carefully, constraining potentially kind of the swings that we're going to see, particularly to the upside. Don't take too much risk. Keep it under control. We need to watch out. The risk for a shock here is significant.
For sure, but don't forget that a lot of institutional investors have already taken down risk a lot, right? For example, on the hedge fund space, I would say we've already done a lot of that. So actually there is scope for re-risking if things in the short term aren't as bad as they turn out to be. And let's face it, we are, not just hedge funds, actually, everyone is very short-term performance oriented. So if suddenly it looks like on the next 1 to 2 months, it's not going to be a disaster, we might get some trade deals, and guess what, earnings aren't going to be completely terrible, then actually, there is scope for re-risking, and retail can still.
How far does that go? How far? I think that's the question I'm really asking.
So S&P can get back to 57, 5,800 in a good case scenario, I think. But I think I would say longer-term money should be looking to sell on those rallies. But for shorter-term tactical money, there is still, meaningful upside, particularly, I would say, in some of the cyclical equities in the short term.
Bernie, one of the things you mentioned in your notes is the role of AI. And, before we were talking so much about tariffs, we talked a lot about AI, so it's nice to go back to that sometimes. The role of AI and the job cut story. So we're watching jobs for a number of reasons, partly because of the tariff threat to the United States, and we're thinking about, is this going to take its toll on the labour market? But some of that might be, just a sign of economic weakness, and some of that might be a pivot into AI instead of people doing jobs. How are you thinking about what the jobs market will tell us and the AI story?
Yeah, I think it's a great question, and it's very linked, and I think the timing of it means that corporates can use that as an excuse, right? So it would be a justifiable excuse to reduce headcount, and we've already seen, I think even SAP mentioned it today, if they need to react, they're not seeing anything, but if they need to react, they will adjust the cost base. And part of adjusting the cost base is going to be headcount. And it's going to be easy for companies to say, well, we can afford to adjust the headcount here because suddenly we are increasing productivity through AI measures. So I think that is something we're going to see come through in the coming quarters, even as potentially the economy starts to slow down. There will still be positive spending on the AI side, which is offsetting some of that.
So companies, just following up on that, companies then that don't have much tariff exposure and can replace people with technology, is that something of a sweet spot? Absolutely.
There's winners and losers. I agree with the guy's point. There's dispersion. The thing is, right now, the correlation has been so high because we've just been thinking about this immediate short-term effect. When you think on a go-forward basis, there's so much differentiation between geographic exposure, supply chain exposure, the ability to cut headcount or not, AI usage. I think that's the interesting story from here.
Should we all go to California to understand what's going on?
Yeah, I mean, we were talking about just now. I think I just come back from 2 weeks in California with a family, and we were all traveling on the Waymo and autonomous vehicles. And at the start of it, my wife was saying, "Absolutely don't know where I'm getting in this." And by the end of it, she was saying, "Bring these to London. They're so safe. The driver's not falling asleep. Don't have to make conversation." So I think, look, this is another one of the examples of how things are changing. Even if we're going to have a sort of more tricky economic backdrop, there will be positive change.
In terms of kind of how we think about where we go from here, an Amundi note caught me. I'd love to carry on talking about Waymos. The Tesla conversation. We're going to have the Tesla conversation a little bit later, so we'll carry on with it then. There's a note out from Amundi saying clients are massively repositioning to Europe. When you think about how the last few years has been, you want to outperform, you're long the US. Has that now changed? It almost does come back to the California conversation as well.
Yeah.
If I wanted to do well, if I wanted my book to do well, I have needed to be long US. I've needed to be long US tech. That has been the trade. Has that now shifted? Should we be massively long Europe, or do we ultimately go back to the AI trade? Do we go back to where we were a few months back? Because I can't work out what phase we're in at the moment or what we're transitioning to.
I mean, I'm not sure any of us can exactly with confidence, but I would say to that question, I don't think it's a blanket, let's rotate everything back into Europe out of the US. Because if you really do believe that we're going to have a global recession, unfortunately, there is a large chunk of Europeans' market cap, which is very sensitive to that, is not going to be resilient to that. So allocators who allocate to, the Euro stocks thinking that they'll be, defended and safe because of that rotation, unfortunately, going to be a negative surprise. What I do think is the case, though, is that what's going to be particularly appealing in Europe is defensives in an environment where the ECB is cutting rates.
Right.
And companies plugged into that German fiscal spending, which are going to benefit and outperform and probably re-rate in a way that they didn't have a chance to re-rate before because people were allocating instead to the US. Now they're looking to allocate to Europe, and so they will look for names which have that potential. So I think there are pockets of Europe which can do very well. I think actually SAP is actually one of the superstars that we have in Europe. We talked before about ASML and LV and Novos, and unfortunately, look what's happened there. I genuinely think SAP is the one which we should have been talking about more and will continue to shine on a multi-year basis because it has something really differentiated, and that will attract capital and allocators to the
And should Europe spend time thinking about the tech it doesn't do, or focus on the tech it does do and do more of it? Bernie, given where the tech experience that you've had of late, and the thinking around AI and where that.
I think it will take to focus on new stuff will require some of the Draghi's suggestions to really be implemented. Will take many years, and I think as we've all seen politically, that's difficult in Europe. I think Europe should focus more on what it really can do, channel more resources towards that. So whether that's champions like SAP, whether that's pockets of actually energy transition. Energy transition is not dead, by the way. I know offshore wind is dead, but actually there's parts of energy transition throughout the world where we can help the rest of the world with their journey, and we should focus on areas like that.
Lunch?
Nearby, I Cabot. I'm off to later today, maybe not for lunch, maybe for dinner, but that's a French restaurant. Amazing Burgundy wine list, very reasonable, good, simple food, but executed really well.
Excellent.
Very good, very good. We should explain that Bernie does have a sideline in restaurant recommendations in his newsletter.
One day mainline.
Honestly, we should do it with more guests. Like, where are you going for lunch today? I think that would be an excellent thing that we could add to the show.
Happy to contribute.
Bernie, great to see you. Thank you very much indeed for stopping by to see us. Bernie O'Connor, Global Multi-Strategy Alpha CIO, joining us from UBS O'Connor. Call 6 looks like this morning. Don't have SAP on this board, probably should, but as you can see, everything appears to be up. Nestle is languishing on the right-hand side, but look at it. Novo, LVMH up quite nicely. Ferrari, ASML up nicely as well. Schneider up by 1.5%, but SAP is the star of the show this morning. Joe Easton's got more details.
So SAP is really the place to start, Guy, because that stock actually rising the most in around 6 years today. Now, Deutsche Bank writing that it is a masterclass in resilience, according to their analyst today in a note. They've seen a massive jump in the cloud order backlog, as we mentioned earlier. So that stock surging on the German market. We're up around 9%, by far the best performer on that market today. Then in terms of BE Semi, this one actually kind of catching everyone by surprise, because most of the takes I read were pretty negative on this, with the margin outlook pretty weak and also the comments around tariffs potentially negative. But potentially it's been saved a little bit by the moves we saw in the US and also in the other chip makers today, given the comments around the Fed and the broader economy. We saw Nvidia up around 3.5% after the close yesterday, so potentially feeding through, but actually extending gains now. So kind of really not moving in line with the analyst commentary, sadly for me, but that one gaining pretty well today. Then in terms of staple goods, we are all buying a lot of Dettol, according to Reckitt. Dettol sales absolutely soaring, but the rest of the business is weak. So we're cleaning our houses a lot, but the rest of the home business actually underperforming, and therefore organic sales at Reckitt actually really disappointing. That is a big move for a company that size. It is one of the biggest weights on the FTSE 100. Danone in Evian water, and also all those yogurts also slipping following their earnings as well. Then in terms of Volvo, it's a pretty weak update from that company as well. This is the truck firm. The orders looking a little bit soft on that one. And remember, there's a lot going on in terms of the environmental regulations in the US. A lot of headwinds, and Volvo looking a bit weak. First quarter adjusted operating profit missing expectations. Then I wanted to look at gold miners. Absolutely slammed this morning. Take a look at some of these. Hochschild Mining London down 13%. Fresnillo down 8%. Endeavour, Pan African all down, following only a 2% drop in the gold price overnight, but a pretty big move for gold. And we did see Asian miners coming down as well. The positive risk sentiment reducing the appetite for those safe havens and hitting the gold miners today. And then finally, speaking of safe havens, Inditex, that upgrade over at BNP Paribas Exane, the bank writing that this is a way to be resilient from tariff worries because of the Zara owners' strong supply chain, apparently is a reason why Inditex will outperform. So that's the real safe haven trade, is the Zara retail owner, according to BNP Paribas, and that one is up 1.8% in Madrid this morning.
Joe, thank you very much. Joe Easton from our equities team with food for thoughts around where stocks are right now, following on from Bernie's restaurant recommendations. Let's get to PMIs over in France. The French April composite PMI falling to 47.3. That was against a forecast of 47.8. So it was already expected to be in contraction territory, and it already was last month as well. It was at 48. So it's dropped down from where it was previously, and it's lower than anticipated. So that's not a great story when it comes to the composite number. Looking at the detail then, manufacturing seems to be better than was expected, but it's the services side that the weakness has come through here in France. So 46.8 is the French services PMI number. I remember a year or so ago we talked a lot about Americans coming to Europe and spending on services, and you know, we'll look into the detail, but that's a question you'd ask, isn't it, whether that continues. Ben
Smith at Air France sort of just cautioning what is happening on the transatlantic route. I thought that was interesting from Air France, from Ben Smith. It's interesting in light as well of the fact that Macron is talking about calling an early election. And you just wonder what is happening within the French economy right now, whether or not he would be brave to do so, given the fact that the economic backdrop does look maybe more difficult than we would have anticipated. The service side of the French economy is still a massive, huge chunk of the French economy. 46.8 is not a good number by any stretch of the imagination. We've seen worse, but that is not a good number.
It's not a good number. We're waiting for the German number. That drops later on this hour. We're not seeing a huge amount of movement in euro-dollar being driven by other things, perhaps, of late. And so we will leave that one there. But we'll come back to this theme with the German data, and then, of course, the Eurozone number drops in less than an hour. Coming up on the programme, Europe's most valuable company tells us business is strong, despite concerns over US tariffs. We will hear from SAP's CEO and dissect the firm's first quarter earnings next. This is Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
No pullback on spending on SAP. I mean, obviously, what they are telling me is, Christian, help me to, drive productivity. Give me more AI on asset management, on supply chain. How can I automate several tasks in my back office functions? I mean, that is, of course, what they are now more and more asking for, given, that they are under financial pressure. But what we are not seeing yet is that they are actually delaying projects or even cutting projects.
Christian Klein's having a good morning. SAP's CEO, the stock is absolutely charging higher. It has been dipping of late, so let's just put it in context, the fact that this isn't a stock that's trading at highs, but it is certainly having a very good day. Charlie Wells is here to unpack the earnings. Investors like it. I think that's probably the first takeaway.
Investors like it. They like the sort of insulating factor that we've got here because tech, we know more broadly, has been under a lot of pressure. There's all these questions about tariffs. But if you look at these numbers, they beat on earnings per share. They missed a little bit on some revenue figures. But the number to focus on here is margin. It was 27.2%. That beat consensus by 250 basis points. And this is a validation of their strategy. And that strategy is moving to the cloud where margins are just much better.
Okay, so the move to the cloud continues. What impact are tariffs having here? This isn't a direct impact story, is it, Charlie? It's indirect.
It's more of an indirect story. And, what they talked about on their earnings call was basically they've got this kind of insulating factor. They have got this current cloud backlog, which is incredibly healthy. They saw growth of about 29%. And this is basically, contracts that they've signed, but revenue that they can't book until the future. And so it's just looking very healthy. Even if we get into a period of uncertainty, of instability over the next, say, 12 months or so, they've got this revenue that they can look forward to, and that is what's bringing a lot of excitement to this stock right now.
Matching, I think you call that.
Yeah.
I'm digging that deep in the recesses. I'm having accounting trauma right now as you talk about that, Charlie, but it's the matching principle.
She tries to repress it, but it comes out. It comes out every once in a while. Is there a read across to the rest of the sector? Is SAP isolated, or is it useful as a barometer?
There's kind of a framework to think about tech right now, especially given tariffs and uncertainty. I think especially emphasis on uncertainty, which is in times like these, companies tend to kind of pull back on IT spend, right?
Yep.
They tend to pull back on consulting. There's not a huge kind of consulting focus at SAP. Sometimes you'll also see some bad signs coming from software companies where they're really dependent on headcount, right? Where the more employees that customers have, the better, because they need, say, more licenses or whatever. Yeah. SAP isn't really subject to that. Some of its competitors are, right? Salesforce, they're a little bit more dependent on these firms having high headcount. If we get into a bad situation economically, the headcount could be cut.
Charlie, thank you very much. Charlie Wells on SAP. Let's pivot from that to another earnings story. Elon Musk says he will devote more time to Tesla starting next month as his stint leading the so-called DOGE, Department of Government Efficiency, is wound down. Investors have taken Musk's decision to focus on the EV maker as a positive move.
Starting probably in next month, May, my time allocation to DOGE will drop significantly. I'll have to continue doing it for, I think, probably the remainder of the president's term, just to make sure that the waste and fraud that we stop does not come roaring back.
Tesla stock rose in late trade after this announcement, the commitment to spend more time at Tesla, despite the company's first quarter results missing analysts' estimates. For more, let's bring in Bloomberg's Craig Trudell. Craig, is investor positive sentiment, is it misplaced? I mean, the numbers were not good.
Yeah, top and bottom line misses. These were really weak numbers, and I think I do have to sort of highlight as well that while Musk was talking about devoting significantly more time to Tesla, starting sometime next month, he also said that as for the remainder of Trump's presidency, as long as Trump wants him, he may devote a day or two a week to this administration. So, is he completely pulling back? No. Is he? Was he at all contrite or sort of apologetic or humble about things? In fact, he was saying that everyone who's been protesting against him is just out for that fraud and abuse that he's fighting, and he's going to keep fighting it.
What is going on? Is this a car company? I'm trying to understand why the stock went up. Is it because he's coming back? Is it because he focused on the shiny things of robotics and self-driving cybercabs and all that sort of stuff? What is it that got the stock higher? What is it that he did that was taken so well?
I've learned not to try to overread into what the stock is doing on a day-to-day basis, because it is quite difficult. I do think a combination of Musk at least messaging that, I understand that I've got an issue here. I do need to kind of, get back to my knitting of running my most important company. It is at least an acknowledgement on his part that, this isn't working. I do think also there was a lot of concern about maybe some delays to more affordable vehicles being on the way. There was, some reference to the idea that actually those are still coming in the first half, but still extremely vague on what exactly those are. And so I do think that there are some analysts, even bullish analysts, who still say that, the numbers were weak and there was kind of shaky details in this report.
Just very briefly, what's the news out of the Shanghai Auto Show? What's the mood? What should I take away in aggregate?
That the Chinese are just absolutely relentless, that, on a week-to-week basis, one major company is one-upping the next. You're not seeing that level of competitive activity in the rest of the auto sector that comes anywhere near what the Chinese are doing.
Great stuff, Craig.
Yeah, thank you very much. Craig Trudell. We'll be back with the German PMIs. That data breaking shortly. We've had the French number. The services number looked pretty weak. We will see what the German number adds to the mix. The ECB already cutting interest rates, though, as the tariff threat looms. Of course, in Germany, you have the fiscal spend to factor in. This is Bloomberg.
You've released
I think a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together. And that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry, you know.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back. You are watching the opening trade. We are getting the German PMI data dropping onto the screen. I managed to just very briefly change my screen, so let me go back to it. The numbers come in below expectations, quite significantly below expectations. Manufacturing PMI comes through at 48, down from 48.3. That actually is above expectations. I tell a lie. The services number, though, is weak at 48.8, below 50. That takes the comp number below 50.
Yeah.
49.7.
Yeah, so we're back below 50 on Germany. That's suggesting contraction, of course, in that economy. And that's the services side again that's weaker. Yeah. And that was the story with France. And so that tells us something interesting, doesn't it? Because for a couple of years, it seems we've been talking about weakness in the manufacturing side in many parts of Europe. And here we have services weakness. And I go back to that point I made about lots of Americans visiting over the last few years and whether that remains the case. We'll dig into some detail and get a proper take on what it is that's driving that services weakness. Do we see not a huge amount of euro-dollar movement?
No, you do. There's quite a lot of movement in the front end of the German curve, though. So the Schatzes is up by 7 basis points at the moment. The rest of Europe's not doing anything like that. France is moving a little bit this morning. Well, actually, France is, to be fair, up by nearly 6. But you are getting some decent movement at the front end of the curve. Euro-dollar, let's have a quick look at and just see exactly what's going on there. Because
hasn't really moved. 114.
Okay. I'll take your word for that. 114. I get some relative strength compared with been
driven by all sorts of other factors a lot of late. So perhaps this little bit of data.
But as you pointed out earlier, we're kind of caught, particularly in Germany, between the tariff hit and understanding the implications of that. Yeah. And what is happening more broadly in terms of the fiscal spend that is coming and how you kind of sequence those, I think is going to be quite interesting. Joining us now, John Taylor, Director of Global Multi-Sector and Head of European Fixed Income at AllianceBernstein. Good morning.
Good morning.
What do I make of this, Joe? What is happening in Europe at the moment? Because Europe is in some ways behaving. The European bond market is kind of doing what investors need it to do, which is acting as a kind of counter to what is happening with the European stock story. But what do you think is going on underlying that? What is happening with the European economy right now?
Things are pretty slow.
Yep.
The most important thing for Europe is that the disinflation trend is firmly intact. So inflation is going to get back to target and maybe even undershoot the target. You can't make that same story up for the US. Yep. Who knows where inflation is going to be over the next year or so. It makes the Fed's decision much more problematic. The ECB, it's pretty straightforward. Today's PMI numbers show again, growth is pretty weak. There's no real inflation problem to worry about. The ECB will and have to keep on cutting interest rates and take them below neutral. So no one quite knows what neutral is, because we had a huge amount of time with negative rates and then policy at 4, but let's say neutral is somewhere around 2, policy has to go below.
So we go below 2?
Yes.
Right. Because there's some resistance within, it seems, the Governing Council maybe to be going below into accommodative territory. But so once you've made that decision to go there, how much further can you go? Like, where can we go? Can we go all the way down to 0 again? Is it? I
think they're going to want to stay away from that negative policy. Right. That was a temporary measure.
So where's the floor, do you think?
Somewhere probably around 1.
Right.
Just to give them a little bit of room. If something then happens, exogenous shock, they can respond. They want to get too close to 0, and then their hands are kind of tied again. But policy should go to 1.5. It could even go lower. It really depends on kind of the next few weeks and months, the tariff negotiations, how big that economic hit is going to be to Europe, and then how much they need to cut policy to help respond to that.
The guy was referencing this earlier. The way that Europe is seeing bond markets act as a haven, John, is that, and whereas in the United States that's not necessarily been the case, that relationship between stocks and bonds disrupted in the States, maybe not so much here in Europe. Is that something you're seeing and something you're leaning into?
Yeah, so we definitely favour having our duration in a global portfolio outside of the US. That's not to say that US yields can't go lower, but there's just much more uncertainty around what's going to drive US yields. It wasn't that long ago that people were talking about 10-year US yields going to 6%. In Europe, I think the story is much more straightforward. There isn't that inflation problem. There's no challenge to the central bank's independence and so on and so forth, and therefore the German Bund is becoming more of the safe haven away from things like US Treasuries. Whether that's a temporary measure or something longer lasting, I think only time will tell.
And is that just European money coming to that conclusion? Or do you think global money is coming to that conclusion as well?
I think global money is starting to come to that conclusion. It'll take time to really see that play out. Part of the problem you have as well is for many global investors, when they're investing overseas and hedging that currency risk back, it doesn't often make sense to own those global bond yields. The more the ECB cut, the more it reduces those FX hedging costs, the more attractive European bond markets become for global investors.
I was talking to Barney Bowager about this yesterday. There was a period, the Greenspan sort of conundrum was that he was hiking rates and you weren't getting much movement in the US 10-year. The curve wasn't responding in the way that he thought it would, and he was confused by this. And the reason it seemed, and Bernanke kind of provided the answer for this, was that the US became the parking place for a lot of global money, and that basically restrained the move that we saw in US 10 years. Are we going to get the exact opposite this time? That the Fed could cut rates and Trump could kind of get what he wants, but actually the cost of money stays kind of relatively high in the US because that international money, as you say, isn't going to be there. And we almost get the kind of the reverse Greenspan.
Yeah, there is a risk of that. I think part of it is the globalization trend that's now sort of seemingly in reverse. Less overseas investors have US dollars as a result of trading, and so they don't need to park that money in US treasuries, etc. You are seeing that steepening of the curve, and it probably can carry on for the time being. It has steepened quite a lot already. You have this issue where the debt to GDP ratio just keeps going up and up and up, and no one's taking any steps to address that, and it therefore needs a bigger term premium that has been playing out really over the last 6 or 12 months or so, even before Trump came in.
So how far through that process do you think we are? If you assume the US deficits are going to get bigger, and the money is not going to be coming from the rest, where can the back end go?
Yeah, it's a really good question, because if we think about it, at the start of the year, it's a much easier trade to put on because the curve was very flat versus history, which made no real sense. Now we're back to levels where it's kind of the 530s curve is roughly around the long-term averages. So it should go a little bit further, given the situation we face today with slowing growth and the deteriorating debt to GDP. Maybe another 25 basis points or so. Part of the problem is I'm not the only person talking about the curve steepening trade, and therefore what often happens is you get these kind of sharp reversals where people kind of unwind and then it sort of goes again. So it won't be a straight ride up, but it probably has further to go over the coming months.
And John, what about feed the gilt story into what we're seeing? Because we've talked about bunds as a bit of a haven. I mean, gilts are doing something else today. We talked about the Treasury story being, less of a haven, certainly the long end. Where does the gilt market fit in amongst all of that?
So the gilt market is living with the hangover of the Truss episode, and so the long end of the gilt market is very sensitive to any news about demand, supply imbalance, so reacting favourably today because of the DMO remit. Gilts are cheap versus bunds. They're trading over 200 basis points higher than bund yields, but they're likely to stay cheap for an extended period of time because of the situation that the Labour government have got themselves in, where they just give themselves a little bit of fiscal headroom, and then if yields rise, which might be a global phenomenon, or if growth disappoints, the fiscal headroom disappears and they have to come back and address it. So they have to constantly prove that they are going to be fiscally disciplined. And therefore...
How do you get away from that need to constantly prove it?
They probably need to break their election pledge and do something on the tax front side and give themselves a much bigger fiscal headroom. The easier way to play gilts is actually probably in the shorter part of the curve, which are going to be less responsive to these demand, supply and balances and going to be more responsive to what the Bank of England are doing. We have a view that the Bank of England are going to cut more than the market is priced in, and actually the more that the Labour government gets challenged on the fiscal side, the more their policies are weaker for growth and actually increase the likelihood that the Bank of England need to do more.
Is there a danger that it gets out of control again? UK government borrowing this morning, the data, official forecast, exceeded official forecast, budget deficit 151.9 billion. These are difficult numbers, and as you say, the margin is incredibly fine. Is there a danger that it could get away from them? What's the hair trigger like within the gilt market at the moment? How sensitive is it?
It's not going to be a repeat of the Truss episode. Right. A lot of that leverage player is kind of been removed. But let's not kid ourselves. The very strong demand we've had for gilts for many, many years has faded away somewhat as pension funds have rebalanced and so on and so forth. During that period, the DMO increased the average maturity of gilts quite a lot. So what they have got the flexibility of doing is actually just reducing where on the curve they issue. The average maturity of gilts is much longer than international comparisons, so they can just issue more shorter-term gilts where there is going to be that more demand, and so they can manage this problem pretty well.
Great to see you. Thanks for stopping by to see us. To see us. John Taylor, Director of Global Multi-Sector and Head of European Fixed Income at AllianceBernstein. Okay, what have we got coming up for you? Could it be the time to buy market volatility? You've got US big tech firms that are about to report numbers. We're looking for Intel as well. We've got SAP to fold into the mix. Claire Playdale-Bouvray is going to be joining us from Lion Trust. The pictures out of the Vatican are amazing.
Yeah, they are really colourful and quite stunning. Pope Francis's body has arrived at St. Peter's Basilica. He will now lie in state for 3 days, allowing the Catholic faithful to pay their respects.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Welcome back to the opening trade, 8:43 here in London. We have strength coming through, in particular for the German market, up by 2.3%. And one of the reasons for that this morning is the strength coming out of SAP. That particular share price up by 9% this morning, soaring the most in 6 years after profits beat estimates for the German software company. Let's bring in Claire Playdale-Bouverie, who is a fund manager at Lion Trust, to talk about all things tech. And there are many things tech to talk about this morning, Claire. Well, let's start with SAP, but we have a host of earnings stories to cover. So SAP doing really well, up by 9%. It's not coming off highs. It's sort of retracing back towards some strength. But what is your view on SAP? You're not such a fan of SAP as maybe some of our earlier guests, I think.
Yes, the results we got out from SAP last night were very, very solid. And I think as an investor in technology, it was comforting to see that companies' earnings power haven't contracted by 30%, even though some of their valuations have over the past month or so. SAP really occupies and epitomizes an area of the market, though, that we're very cautious on, which is legacy enterprise software. And this is because we're seeing a tectonic shift in the way that software is architected. And what we're seeing from a number of AI-native companies is the ability to undercut the likes of SAP by as much as 30-fold on price. You think about this, if you're built on accelerated computing, which is 100 times faster, 98% cheaper than traditional compute, that's an inbuilt architectural advantage. So what we see over the next 5 years, and we think this disruption is going to be very, very gradual because SAP, 86% of its revenues are recurring. These companies have sticky business models. Exactly. I mean, this is why they've been such fantastic investments over the past 10 years. But we don't think that these moats, that these software as a service business models, we don't think they necessarily hold anymore, because we're going to have to see a recalibration of pricing models if they're going to compete with some of these challenges.
Can SAP migrate to that world, though? It was interesting, we were hearing from the CEO a little bit earlier on, talking about the fact that he is shifting his business in that direction. Are you saying that that is a journey that they're going to take too long with, and ultimately, therefore, others will get in first?
It's an excellent question, and SAP is certainly making significant strides. We think they're further along than a lot of their enterprise software peers. Yeah. But if you think about the sort of building a software stack, it depends upon the foundations on which it's built. The analogy that we could draw is sort of your house. It depends upon the foundations on which it's built. Now, it's not impossible to re-architect, but it's very costly, and it is quite complicated. So if you're built on the wrong unit of compute from the outset, i.e. CPU, traditional compute, that's got to move over to accelerated computing. SAP are moving their customers to the cloud. They are rolling out some very decent AI offerings. There are a number of great stats last night thrown in the mix. I think their AI agent is now saving its customers 90 minutes a day. These are all great, but they're being built on top of legacy compute.
Okay, and thinking of things that have been around for a while, you can tell us if it's legacy or not, but Intel is also in focus this morning, announcing plans this week to cut more than 20% of staff, this according to our reporting. Layoffs aimed at cutting bureaucracy. We've got a new CEO in place, and we understand he wants to focus much more on the engineering. Disappointed with the way that this business has lost ground to the likes of NVIDIA, perhaps?
Yeah, the announcement we got out of Intel this morning wasn't really a surprise to us. And going back to what we just discussed about this shift, Intel's on the wrong side of this shift. They really epitomize the traditional compute era, and we're now moving to accelerated compute. If you think about the 1980s, the Wintel era, the surprising part to us is that actually people aren't questioning the Win part of that, the Microsoft dominance. We think that over the next 5 years, that's going to start being a question that people are asking. But with Intel, really, the design flaw in their business model stemmed from the decision to be an integrated device manufacturing company. And that meant that both on the foundry side, they fell behind TSMC because they were trying to make things that their own team were designing for them. And on the design side, they fell behind AMD and NVIDIA. And they're now 10 years behind and struggling to catch up. So not all that surprising, and we don't see an obvious route out for this company.
NVIDIA's traded this morning. They traded last night at I think overnight it's trading at 102. Do you like it at 102? Is this a good entry point? What we're seeing at the moment is that a lot of people are taking money out of the States. Now, when they were putting money into the States, if you wanted to kind of G up your portfolio and you wanted to add a little bit of sparkle into it, you'd buy some NVIDIA, and it did really well. That money's beginning to flow back out again. How do I separate out the fundamental story with NVIDIA at circa 100 from the end of it US exceptionalism story, where people were kind of using Intel as the turbo for their portfolio performance? How do I work out kind of what's what?
So the opportunities that we're seeing at the moment in the market and have seen over the last month during volatility have definitely been on a stock-by-stock basis. We think it is a stock picker's market right now. And yes, we do like NVIDIA at 100. We liked it even more when it was trading on $93 a share in the wake of the tariff announcements. And these are the types of companies that we have been very active in topping up, because there is very little that's changed in these companies' fundamentals, in their earnings power, their trajectories. NVIDIA, if we think about
was it being valued fundamentally, though? Or was it being valued because everybody's just pouring money into America?
So, I mean, last year, NVIDIA grew its earnings at almost double the rate of its stock price. So it is very much a fundamental story. And the outlook, though, which I think is where you're getting, I'll be buying into the promise of NVIDIA's continued growth. The outlook is still very, very strong. And this was underscored by TSMC's report last week. What we heard from TSMC was pretty astonishing. They're still expecting AI accelerators to double this year, but more importantly, over the next 5 years, they're maintaining that long-term outlook for AI accelerator growth, 40% compound annual growth rate. Now, if we take a very conservative haircut on that, and this is conservative because NVIDIA doubled its data center revenues last year, and say NVIDIA grows its data center revenues 30% compound annual growth rate over through the decade, you arrive at data center revenues of $430 billion, and consensus has penciled in $350 billion. So we think this company is being significantly undervalued at the moment.
So when 30% growth is conservative, we understand what you mean. So that's something leading edge, I suppose, isn't it, when we're talking about NVIDIA? Back to the sort of leading edge versus mature markets theme, Alphabet also reporting this week in terms of the tech landscape. And you say Google is in the innovator's dilemma. Talk to us about the headaches at Google.
So there's a certain irony that we've got a DOJ case investigating Google's illegal monopoly in search at precisely the same time that Google is being challenged for the first time in a decade. But what we've seen really since the launch of ChatGPT in December 2022, as well as the launch of Perplexity, which is a fantastic app, I use it the entire time, what we've seen is that paid clicks per ad for Google have fallen off a cliff. They've declined over 30% since Q4 2022, and what you've seen of the worldwide active users of ChatGPT grow month on month by 15% or so. Now, the reason Google's in such a tricky spot is that they command 90% gross margins and 90% market share in search. So in order to compete with these chatbots, which actually give you answers as opposed to pages with sponsored links, they've got to undercut their very high margin revenue streams. And at the moment, they're going for a compromise approach.
They're putting some AI
They're putting some AI, but they're still trying to put ads in there. And that detracts from the user experience. And this will be a gentle erosion of market share and margins. People are very habitual, but what you're seeing in the younger generations across geographies is that they're not going to Google anymore for their information.
No.
That makes me feel young. I've occasionally dabbled in a chatbot, so that makes me feel young. Thanks, Claire.
Well, yeah, nice. I have to say, watching my children use this stuff, it's amazing how they are migrating and migrating quite quickly. Though my son was slightly frustrated yesterday that one of them couldn't understand him quite as well as he thought it should have done when he was speaking to it, which was the way that he increasingly uses it. Claire, nice to see you. Thank you very much indeed. Lion Trust Fund Manager, Claire Playdell-Bouvray. Thank you very much indeed. Okay, let's talk a bit about what we've got coming up for the rest of the day. We're not done. PMIs continue.
Yeah, we've had the PMI news out of France and out of Germany. We do see a little bit of downward drift on the euro now in terms of what impact this had. And you were drawing our attention to some of the moves in the Bund a little bit earlier on. But the story has been disappointment around services, hasn't it, so far? And then we get the overall Eurozone number a little bit later. UK PMIs, we get US PMIs as well. We hear from Andrew Bailey. So there's lots on deck in terms of the conversation. And the Fed Beige Book, I think that'll be really interesting.
You're excited by
anecdotal. I'm excited by beige. What can I say? Yeah, all of the little anecdotes about the US economy. I'm looking to my right because Valerie Teitel has joined us, and I'm sure she gets excited about beige as well. Valerie, where should we start? Do you want to talk about where shall we start?
Well, look, I do think the Beige Book will be interesting, that kind of off-the-cuff information from business leaders and how they're interacting or interpreting the tariffs and reaction will be important. But one thing I think is going to be a bit more important going forward is keeping our eye on the lawsuits brought forward against Trump tariffs. Now, there have been a few of them now. They've piled up. It's been 3 weeks since April 2nd. And many out there are talking about a lawsuit by a libertarian think tank representing small businesses in the U.S. Court of International Trade, which is squarely focused on the president's use of the emergency powers. That's the IEPA, the IEPA Act that he's been using in order to implement these tariffs, saying it's unconstitutional to use IEPA to implement tariffs, and arguing the president has overstepped his authority. Now, the important date in your calendar is May 6th. Next week, this court will have a hearing over possibly allowing an injunction, which would be an emergency block on the tariffs until the court decides on the case. Now, this could be the first ruling on whether a court would put the tariffs on hold actually during the process before they make a decision, but it could be huge. And many people are talking about this because the likelihood of one of these cases making it to the Supreme Court, while that is small, Guy, it could be very large because since 2021, the Supreme Court has actually invalidated several presidential initiatives under the IEPA rule. With the Biden student loan forgiveness program, the COVID vaccine mandate, even the pandemic eviction moratorium were all eventually invalidated by the Supreme Court. So, even though the chance is small, the likelihood of one of these making the Supreme Court could have huge ramifications for presidential power.
You do wonder whether ultimately, though, that when presidents, and FDR is the obvious example, have gone up against Supreme Courts and the Supreme Court, there's always been some sort of understanding that was ultimately reached. Trump will say, "This is the will of the people. They have voted me in. This is what I'm going to try and do. Why should I be frustrated by the court, even a right-leaning court like the Supreme Court?" You do wonder whether this is a speed bump rather than a permanent kind of end to the story.
Yeah, but you have to think that even though the chance of this is very small, just think about the market reaction if the court does impose a temporary injunction on these tariffs, meaning they're completely invalidated. I mean, that would be a day would be limit up in the equity market. So even though the risk is small, we keep our eye on its developments.
Okay, certainly worth putting on our radar. Thank you very much, Bloomberg's Valerie Teitel. So we've had some of the PMI data. We'll get more of it coming up. We'll also be hearing from all of these IMF and World World Bank meetings, of course. We'll have full coverage of those spring meetings. We'll be hearing from the Bundesbank president at 12:30 p.m. UK time, so stay with us for that. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Markets bounce back after President Trump diffuses tension, saying he has no intention of firing Fed Chair Jay Powell, and he plans to be very nice to China. Elon Musk pledges to refocus his attention on Tesla after disappointing first-quarter earnings, telling investors his work at Doge is mostly done. Plus, the U.S. Secretary of State, Marco Rubio, pulls out of talks on ending the war in Ukraine. We'll discuss what that means for Donald Trump's efforts to find peace. Now, first thing is first, we're seeing a bit of a relief rally. Certainly, we're seeing across assets when it comes to the S&P futures gaining almost 1.9%. Look, the U.S. 10-year, I know it's been a benchmark, actually, of risk out there at 4.35. I'm looking forward to a good conversation, actually, on treasuries, but also gilts and the bond market space with PIMCO shortly. Euro-dollar, 113.91, and then Bitcoin, for the first time in 5 months, above 90,000 at 94,139. Now, if you look at the European markets map, again, there's a bit of a relief rally. Stocks are jumping, bonds are rising, relief sweeping across global markets after the Trump administration diffused two things, as we were saying, the fact that he says he will not fire Jay Powell, but also some of the tension regarding China that really rattled investors. The CAC gaining 2%, similar gains across the board, the FTSE gaining 1.4%. Now, we're also getting some Euro area PMI figures. Eurozone April composite PMI falling to to 50.1. The forecast was 50.2, so nothing huge. We had Tesla earnings. I'm looking forward to also speaking to Craig Trudell, our global auto star on Tesla. The pre-market, it's 5% higher. Also, we have the story that Elon Musk will, of course, go back to taking care of his business instead of focusing so much on DC. Intel pre-market is one we're looking at, and then the other one is also Harley Davidson, after we understand that India could stop some import tariffs from the famous motorbikes, Intel gaining 3%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
So good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the Trump administration has diffused some of the tensions that had rattled financial markets, walking back comments on both the Fed and China. Now, President Trump says he has no intention of firing the Federal Reserve Chair, Jay Powell. And on trade, the U.S. president also floated cutting tariffs on China substantially.
We're going to be very nice. They're going to be very nice. And we'll see what happens. But ultimately, they have to make a deal. 145% is very high, and it won't be that high. I think we'll make a deal with China.
Well, we'll discuss what all of that means for the markets with Mohin Mittal. PIMCO's the Chief Investment Officer for Core Strategies. Also joining us, Ross Matheson, Bloomberg's EMEA News Director. So thank you both for joining us. Ross, first of all, let's get caught up in what happened over the last 24 hours. So first it was Scott Bessent saying, look, everything will be fine with China. And then President Trump was pretty forthright. I don't know whether he's looking at the markets or he just wants things to ease down a bit.
Well, it's an indication maybe that at least tariffs won't go higher in the near term. But for tariffs to come down, we're really needing to have a proper sit-down conversation, and those talks have to happen. And there's no sense of when those talks might happen or who might be involved. Particularly what you really need is Donald Trump and Xi Jinping, the president of China, to talk directly. So an indication at least that he doesn't want to keep pushing things in this tit-for-tat gambit at the moment. But it doesn't mean that tariffs are going to drop significantly and immediately. And it does also require China to say, well, we'll agree to do this if you do that. So there has to be that negotiation. And the commentary from China overnight has been interesting. They indicating again in their foreign ministry briefing today, they're very willing to have conversations with the US, but also Xi Jinping saying in comments overnight that, trade wars benefit nobody. He's not really shifting heavily on the rhetoric, especially when it comes to the US. And so you can see that China's been very willing to play hardball with the US on this. And their economy arguably is a bit better insulated against some of this trade behavior that's happening. And so there has to be an impetus for China also. And China doesn't like to give concessions. So we're not necessarily in the realm of a full pullback at this point, but opening the door at perhaps if we can get towards talks, maybe we can get to some kind of understanding.
I mean, markets were very quick to react, right? And they're definitely taking some relief on the comments on both Jay Powell but China tariffs. Has a dramatic shift out of U.S. assets been overblown?
Yeah, I think markets have certainly reacted a fair bit to the news of the last few weeks. I think from our point of view, what we think of it is take a step back and look at what the situation is overall telling you. And when we think about it in that sense, what we observe is that even before April 2nd, we were starting to see the weakness in the data in the U.S. Sentiment data was weaker, but so was a little bit of the hard data like the credit card data, retail sales data, or the travel data. Since then, the uncertainty has increased quite meaningfully. So what that means is that the consumers as well as the corporates will be a lot more cautious in terms of thinking about spending and investments. Normally, in such an environment, you expect yields to go lower, treasuries to rally. What we have seen is actually yields move higher in the last 3 weeks. So why did that happen? One narrative, as you mentioned, is basically the idea around foreigners reducing allocation to U.S. assets. I think certainly some of that is likely happening as the uncertainty around the U.S. is creating that anxiety in the minds of the foreigners. But then also is a big global delevering that is happening because the volatility increased so much that it created VAR shock in many of the levered strategies. So as that happened, rates moved higher. But in the context of the longer-term fundamentals, which I mentioned, kind of economy slowing down, growth weakening, If you think about it in the next 6 month to 1 year horizon, chances are growth will be lower than what it is today, near 0%. And in that sense, rates look quite attractive. Treasuries start to look quite attractive in the 5 to 10 year point.
Well, I mean, given all the volatility, is today an opportunity to re-risk portfolios on a possible trade deal? Or is it too soon?
I think there will be volatility, there will be a noise, and that volatility will create, kind of more moves in both the rate markets, credit markets, and equity markets. So the question is, where is the opportunity? From our point of view, when we look at kind of where the opportunity is, the rates market stands out. In the US, in UK, in Australia, the Treasury, the gilt, and the Australian government bond market stand out, where basically the market is not fully pricing in the growth weakness that this scenario is creating. Market is assigning reasonable probability or high probability to the scenario that, for example, for the US, foreigners might reduce allocation to US holdings, but not assigning as much probability to a scenario that growth will weaken, thereby that opportunity in the rates markets. I think on the credit and on the equity market, we still have to be a little bit kind of cautious. There will be more volatility, and we have to recognize that this environment creates a scenario where growth prospects are much weaker, which may not be as strong an environment for credit or for equity markets.
Right. We also spoke to Venkat, the chief executive of Barclays, yesterday, and these were his thoughts on the U.S. as a reserve currency.
It's 100 years, 80 years, 100 years of dollar strength, so much so that important commodities, gold, oil, are denominated in dollars. Dollars are part of the payment system. When countries talk to each other, they represent their GDP and various figures in dollars. I think undoing that will take a long, long time. And, 3% in foreign exchange terms is not that much.
But given the uncertainty and unpredictability of the policy agenda of the Trump administration, how much, premium do you think investors should be attributing to U.S. assets?
Yeah, so I think firstly I agree. I think the dollar will remain the reserve currency. I think a big portion of the trade happens in that, and there's not a clear alternative to what that is, to what a reserve currency alternative to US would be. So dollar stays as the reserve currency. Now the question around how much premium that investors will ask, I think we have seen a meaningful increase in that premium already getting priced in, particularly in the rates market. Even the dollar now, at least as of yesterday, had moved to levels 3 years ago. So there is already a meaningful premium that has been assigned to that. Certainly that can move a little bit more. More premium can be assigned. But I think for many investors like ourselves, it's also starting to create opportunities, particularly on the rate side, to take the other side of this premium that is being built in because of the growth backdrop. On the dollar side, I think usually when currencies kind of move, it tends to be a little bit more longer-term trend. So there can be additional weakness in the dollar over the long term, but we also recognize that it has become a little more of a consensus trade in the market in the last few weeks. So any kind of headlines has the potential to cause a little bit of a snapback rally in the dollar as well.
Okay, thank you, Mohit. I want to ask you about the Fed in a second as well, but then the other news overnight was Elon Musk taking a bit of a backstab from the White House. Is this on concerns? Do we know what happened between him and the president, or does he actually feel that his job is almost over?
Well, he's coming up on the 130-day limit for his position as a non-official government employee, where he was going to have to probably step aside. There'd been a lot of talk already that May would be the end of it for him and he'd start to pull back, and particularly, again, giving impetus from the Tesla numbers that we saw last night. The need to get back to his business and pay attention to it is very real. I mean, they've got new models coming up, they've got the robo-taxi stuff. He needs to really get in there and pay attention to his company. But the timeline does match up with what we were really expecting for him to pull back. And what he's doing is he's got his lieutenants in place. I mean, Doge won't just stop dead because he steps aside. That effort will continue. As we've reported, there are other significant figures in the US administration, government officials who've been architects of this policy also, the idea of really cutting back the US government in all the agencies, including the Pentagon, as we're seeing now, the State Department under Marco Rubio as well. So this is not a policy that's going to go away just because Elon Musk is no longer there front and center. It may become less visible and it may become more orderly, one could argue, but it's not going to stop. But it really is a sign, obviously, that Elon Musk is saying, I need to get back and pay attention to my business. There's possibly also a bit of a rift, as we know, between Elon Musk and Donald Trump over tariffs. And Elon Musk arguing that tariffs are obviously not good for his business.
Ross, I also want to ask you about the Fed. Now, President Trump has pulled a major about-face when it comes to his stance on the Fed. Trump now saying he's not getting rid of Jay Powell, despite criticizing the Fed chair in a series of public comments.
No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates. This is a perfect time to lower interest rates. If he doesn't, is it the end? No, it's not. But it would be good timing. It could have taken place earlier. But no, I have no intention to fire him.
Ross, we were talking about, uncertainty and unpredictability, a word that I apparently can't say, in terms of policy. But the concern is that actually markets have to take him at face value, but then he walks back comments.
Well, that's right. I mean, he was using language around Jerome Powell that's more than you'd see kids in the kindergarten. I mean, calling him a loser, calling him incompetent, talking about, the sooner he's terminated, the better, and then suddenly saying, no, I'm not trying to fire him. And that relationship is fundamentally, if you call it a relationship, is fundamentally broken no matter what. Donald Trump is still going to keep talking publicly about where he wants interest rates to be and lambasting Powell if they're not where he sees them going. Perhaps three factors here very quickly. One is that obviously he's watching the market and he knows that really digging in to try and get rid of Jerome Powell would cause a massive roiling of the market, including the bond market, which is the one he seems to be watching. He could figure it's just too much of a hassle to try and do it. I mean, it's not very easy for him to do this. It's complicated and arguably he doesn't have the legal ability to do so. Jerome Powell's term, I think, is up in about a year, so maybe he figures he can just wait it out. And thirdly, Jerome Powell's quite useful in a way, because if the economy doesn't go where Donald Trump wants it to go, you've got a fall guy.
Yeah, I mean, the concern again for markets is that there was, pricing in the markets of somewhat of a risk, but actually they didn't really price it fully, because if the Fed chair was fired, it's all bets are off. So how do you deal with this, again, uncertainty?
Yeah, I think you're absolutely right. Like, I think, in general, any kind of intervention towards Fed's independence is not something that the markets appreciate. Markets like certainty. This adds to an already an uncertain environment that has been created because of the tariff policies. So in a scenario where the intervention continues, that would be negatively viewed by risk assets across equities, across rates markets, across currency. It will certainly increase the risk premium even further than what it has happened.
You were mentioning, the behavior of U.S. Treasuries that were trading a bit like risky assets. Do you think their haven status is in question?
I think it has performed that way in the last few weeks. But if we look at the longer term, so if we look at, for example, what happened from January to March, when equity markets declined pretty significantly, Treasuries rallied. Similarly, if you look at the August 2024 period, when we had the big Japan carry unwind, equities declined significantly, rates rallied. You go back to 2023, the Silicon Valley Bank situation, equities declined, fixed income rallied quite significantly. So this last 3-week period is a little bit unique in the last couple of years. As we talked about, there are two reasons. One is around foreign reduction. Second is around a levered position unwind. For patient investors like ourselves, it has created opportunities to add exposure. So that's how we would think about it.
But PIMCO still prefers bonds outside the U.S., right?
We like the U.S. exposure, but we also like U.K. as well as like Australia exposures, as I was mentioning.
What else are we looking for, Roz? I mean, there's so much, again, uncertainty, domestically also with what's happening with the defense secretary, and it's things that the market's not pricing. Do we know how Donald Trump measures success? Like, does he want to keep, Mohit happy with the bond market, but then gets on with actually delivering on what he was voted on?
Well, he clearly wants to get some trade deals done, and a lot of focus this week, obviously, on India with the Vice President J.D. Vance there, and very, very warm words for Narendra Modi, the Prime Minister of India. So he does clearly want to get some individual runs on the board, but he wants to do that on a bilateral basis. He does not want to be negotiating with countries as a bloc, which is why also the EU could be problematic for him. So he wants to demonstrate to the American people that he's delivering on some of this. He's slapped tariffs on everything, but now he wants deals. And that's very clear. Those deals may take months, but he wants to show at least progress towards them, including potentially with the UK, with Rachel Reeves in the US. So that's one demonstrable, obviously, he wants to show. And then physically demonstrating how much he's cutting government, that's another one. And Ukraine, well, getting a deal there, obviously number 3.
And Mohit, when it comes to liquidity and market functioning, I know there were a couple of concerns over a couple of days. Do you worry about that actively?
I think it's certainly a focus for us. We look at it quite actively. But for now, when we look at over the last 4-week data, 3-week data, market functioning has been normal. There has been a little bit widening in bid offer, as you would expect. As volatility picks up, you see that in the treasury market, you see that in the credit markets as well. But broadly, in aggregate, the market functioning has been normal. And I think a lot of policymakers look at that as well, and they get comfort that certainly there has been more risk transmission across the public markets, which is also important that public markets are able to do that risk transmission, even if a little bit of a bid offer increase can happen during periods of volatility.
Mohit, thank you so much. It's so great to have you in London. Mohit Mittal there, PIMCO's Chief Investment Officer for Core Strategies, and our very own Rosalind Matheson, Bloomberg's EMEA News Director. Now, coming up, we'll discuss the outlook for oil and the impact of Trump's tariffs and geopolitical tensions with Fatih Birol, the Executive Director of the International Energy Agency, who's also here in London. That's next, and this is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the 3 major oil forecasting agencies have all made hefty cuts to their demand estimates for 2025. The projections by the IEA, OPEC, and the EIA follow President Trump's tariffs and the decision by an alliance of producing nations to speed up the return of barrels removed from the market 2 years ago. At the same time, geopolitical tensions escalate. The risk of energy supplies, of course, remains a major concern. And this week, the UK government and the International Energy Agency are hosting an international summit on energy security in London. Well, I'm delighted to be joined by Fatih Birol, the Executive Director of the IEA. Mr. Birol, thank you so much, as always, for joining us. So what concrete action do you hope or expect to achieve, actually, at the summit in London on energy security?
So first of all, the first action is to bring all these governments together. And we have tomorrow 60 governments from all continents, from emerging countries, advanced economies, and the CEOs of top energy companies. At a time when the geopolitical uncertainties are going so high and the fragmentation around the world is growing, to bring everybody together around the table is, of course, a major asset for the discussions. But what I wanted to see from this meeting is there is a common understanding about the current and tomorrow's energy security risks and what we can do altogether.
Can oil remain below $70 a barrel? And actually, if it does, what kind of impact would that have on the economy and oil supply and demand?
I think, again, when we talk about uncertainties, oil markets coming on the top of it. But when I look at the numbers, our numbers, this year we expect the oil demand to increase about 700,000 barrels per day. And the production growth is significantly higher than that. In that context, if there are no other surprises, we may expect the oil prices seeing a downward pressure further.
Fatih, how's it been actually dealing with the Trump administration so far? Have there been any demands on changing the outlook or some of the models that you use to predict?
No, we work with all administrations, U.S. and other countries in a respectful way. They have their own views. Other member countries have their own views. But we work in a good spirit with our colleagues from the new administration. For example, we talk about the security summit tomorrow. We have colleagues, top officials coming from Department of Energy and Department of State coming to this meeting, as well as other 60 countries.
Your views on OPEC Plus, I mean, was it a bit reckless to actually speed up the pace of oil supply increases when demand is shaky and we're in the middle of a trade war?
I think they may have their own thoughts and strategies, but I would say it is also one of the uncertainties how they are going to move in the next weeks and months to come in a context where we see a surplus in the oil markets, and therefore it's up to them to decide where they are going to go. But as last year, this year we also expect a rather slow oil demand growth, limited oil demand growth in the markets, mainly driven by what's happening in China.
Fatih, I mean, the other thing, of course, and there's a bit of relief on some possible deal with China at the moment. Does that change what you're expecting, again, demand to do for the price of oil? Is that a real game changer? I
think there are two reasons why we expect oil demand growth to be rather weak compared to previous years. One of them is structural, which is the China and other countries' economic growth is slower than in the past, and electric cars coming strongly. The second one is the trade wars. If there is a change in the trade wars context in a positive direction, it may well increase the global economic outlook, and we may see our oil demand may be slightly higher than what we have now.
Will you stick with the forecast that global oil demand will stop growing before the end of the decade?
I think with the current policies, current economic outlook, current technological trends, we expect the oil demand growth will slow down considerably in the next years to come. In fact, we are seeing last year and this year, and this may well mean that the oil demand come to a certain level and a peak level and stay around there. It is still very high, about 100 million barrels per day, a lot of oil to supply to the markets.
But, I mean, the other big unknown is, of course, what happens to Iranian oil supplies, given we're hearing from the Trump administration that, you know, they want to maximize pressure, but at the same time trying to reach a deal to lift sanctions. So how do you do the outlook for that?
I mean, if I have to look at the oil markets today, there are many uncertainties. One of them is, as we just discussed, what happens with the trade wars. The other one is the economic outlook, and third one is the sanctions. Iran, Russia, Venezuela, what will happen there will also have an impact on the markets. The more oil comes to markets, the lower the price levels will be.
But for Iran, it's particularly difficult, actually, to understand what will happen because it's geopolitical.
I think it is very difficult for all of us to understand. There is a lot of discussions going on there, but we hope that there will be a good solution for everybody in this planet.
Fatih, are you worried about increasing instances of negative pricing in Europe's spot power markets? And what does it tell us about renewables?
Not for the time being. It's not a structural thing, not for the time being. And we are seeing that the renewables are growing very strongly in Europe. There are still some teething problems in terms of the availability of grids and the capacity markets, but this will be solved, and it's not a structural issue for me.
What are you most optimistic for the energy markets in the next 12 months?
I am very optimistic because a lot of new technologies are coming. The innovation technologies, the electric cars, the batteries, solar. If I give you one number, last year of all the power plants installed in the world, more than 80% were renewables and nuclear power, two carbon-free energy sources.
But we also have a lot of data centers. We're always on our phones. And
That's
so that
right.
consumes a lot of energy.
You are completely right. Completely right. We are entering an age of electricity. We have still oil, gas, but electricity will be the source of energy which will put its stamp in this century, in my view.
Fatih, thank you so much for joining us. As always, that was Fatih Birol, Executive Director of the International Energy Agency. Now, coming up, top diplomats, including Marco Rubio, decide to skip Ukraine peace talks in London today. The move raising questions about the state of negotiations. More on that next. We'll also speak to Bill Browder in a very short time. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO? It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Well, good morning and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Markets bounce back after President Trump diffuses tensions, saying he has no intention of firing the Fed chair, Jay Powell, and he plans to be very nice to China. Tesla jumps pre-market as Elon Musk pledges to refocus his attention on the automaker after disappointing first-quarter earnings, telling investors his work at Doge is mostly done. Plus, U.S. Secretary of State Marco Rubio pulls out of talks on ending the war in Ukraine, putting Donald Trump's peace efforts in doubt. Now, let's get more on that story now. The U.S. Vice President J.D. Vance says both Ukraine and Russia will need to give up some territory in order to strike a peace deal. It comes as the U.S. Secretary of State and European diplomats are also skipping peace talks in London today, effectively downgrading the level of the meeting. Greg Sullivan, Bloomberg's Russia and Economics Government Editor for Bloomberg, joins us now. So, Greg, thank you for being here. What can we actually expect to see out of those talks?
Well, as you said, it does appear that the talks have been downgraded now that the foreign ministers and Secretary of State will not be there. The talks were initially supposed to be a follow-up to a round of talks last week in Paris, where the U.S. essentially laid out proposals that they saw set for a ceasefire deal. Among those proposals, of course, were the U.S. recognizing Crimea, taking Ukraine's NATO bid off the table, and essentially freezing the conflict more or less along the lines of contact where it stands right now. Today was supposed to be a follow-up to that. It does seem that the U.S. is looking for a yes or no answer, given comments from the administration. As you said, we just heard from Vice President J.D. Vance, who said that they have put forward an explicit proposal and they want a yes or no. So that does appear to be what the U.S. is coming to the table to find out in these talks.
Greg, how has Ukraine responded to U.S. proposals for the ceasefire? What is President Zelensky trying to achieve, seeking a meeting with Trump at the Pope's funeral?
Well, Ukrainian President Volodymyr Zelensky is definitely in a difficult position. This is a tough spot for him. These U.S. proposals are very hard for him to swallow, and he's already said that Ukraine will not recognize Russian control of Crimea. He has said in the past that he does not want, that Ukraine will not cede sovereign territory, which is obviously one of the proposals. And if the conflict is frozen at the current lines, that's a bigger sacrifice for Ukraine than Russia. Ukraine has been trying to gain back territory that Russia took first in the 2014 annexation of Crimea and then later in the 2022 full-scale invasion of Ukraine. So for him, he's now got this difficult task of balancing this, keeping the U.S. on his side, trying to instill doubt in President Trump on Vladimir Putin's intentions. It's a tough role, and clearly meeting with Trump is meant to try to thread that needle.
Greg, thanks so much. Greg Sullivan there, Bloomberg's Russia Economy and Government Editor. Now, Sir Bill Browder has written about his experiences exposing corruption in Russia, and last year was knighted for his services to human rights. He's the best-selling author of Freezing Order, which led a campaign to persuade countries to adopt sanctions on Russian officials believed to be responsible for human rights abuses. Well, Bill Browder, co-founder and chief executive of Hermitage Capital, joins us now. Sir Bill, thank you for joining us. Do you think Russia will actually abide by any deal that Trump reaches with Putin to end the war?
Well, Putin has a long history of not abiding by any deals. He lies, he makes promises, and he doesn't keep them. And there's very specific promises he's already made in relation to Ukraine. There was a previous ceasefire deal called Minsk I, and then there was Minsk II. He broke both of those ceasefire deals. And so it's kind of hard to imagine that, first of all, that he's actually going to, that there's going to be an agreement that he's going to be happy agreeing to. And secondly, if he does agree to anything, he will violate that agreement very quickly. This is what he does. There's not a word that Vladimir Putin says that can be relied on. And so it's all really very frustrating for anybody who's a supporter of Ukraine to watch this process play out, in which Ukraine is being forced to make unbelievable concessions. Putin is being rewarded for his aggression, and there's no security guarantees for Ukraine.
So, Sir Bill, how do you see the risks and the probability of a resumption of the invasion a year or so later, if there is an end to the war?
I think that the war will carry on in all sorts of different formats, no matter what Putin agrees to this week. And from what I can tell, I don't think he's going to agree to anything this week, and I don't think Ukraine is going to agree to anything this week. It doesn't look very likely based on the demands that are being placed. But if there was an agreement, and perhaps I'll be wrong about that, you can't rely on Putin at all. Putin will continue to push on all different areas. He certainly could use some time and sanctions relief to rebuild his military, and I think maybe if he were to agree to anything, that would be the basis for his agreement. And you could be 100% sure Putin will be back at it with Ukraine, and Putin may very well be at it with other neighboring countries like Estonia, Latvia, Lithuania, Poland. And so from the Europeans' perspective, any of these surrender type proposals that are being forced on Ukraine are very negative and very risky.
But what are the choices that Ukraine has if the U.S. walks away? Do you believe that the Trump administration will walk away if they don't feel like a solution can be reached?
I believe that they pretty much have walked away from Ukraine based on everything that's happened. There has not been any new military aid agreements from the United States. I think that it's entirely plausible and possible that the U.S. does walk away, and if they do, then I think it's very likely that Ukraine will carry on fighting. They'll carry on fighting with the support of the European Union. I think there's a very high probability that at that point, the European Union will confiscate Russian central bank reserves, which are currently frozen in the European Union, and use that money to continue funding Ukraine. The Ukrainians, everybody always downplays the Ukrainians from the day one. Everyone said the Ukraine was going to lose in 3 days, Russia was going to win. But Ukraine has got a very strong reason to continue fighting, which is that when Russia occupies their country, terrible things happen. The people get tortured and killed, women get raped, children get kidnapped. And so for the Ukrainians to sort of give up, it seems like a very unlikely possibility based on the realities on the ground.
So what's the way forward, even if Europe steps up support to the extent it can? How long in the scenario could Ukraine hold up against Russia?
Well, if the Europeans continue to support Ukraine, and if they support Ukraine in the form of lethal weapons, Ukraine at some point could end up with a military advantage, at which point they can negotiate a proper peace deal as opposed to one being forced on them. And that sort of has to be what they're looking for, is a situation where they're negotiating from strength, not negotiating because the United States is pulling out. And I think that the United States pulling out of this whole thing is pretty much already been decided. And so it's just a question of how to manage that pullout in a way that's least painful for Ukraine and for Europe.
Sir Bill, what's your advice to companies and investors thinking of a return to Russia if sanctions are lifted as part of any peace deal?
Well, I was once the largest foreign investor in Russia until I was expelled. My offices were raided. My lawyer was arrested, tortured, and killed. And then I was pursued around the world with Interpol red notices by Russia. And so what I can say is, and this happened long before any invasion of Ukraine, it happened even before the invasion of Georgia. And what I can say is that Russia is a totally uninvestable country. It's a dangerous country. There's an absolute sort of no rule of law, total corruption. And anybody who ventures into Russia would be doing so at a huge, huge risk. And I would say it would probably negligent, if they're a public company, negligent going into Russia based on those risks.
But there's a belief in the Trump administration that Donald Trump could find a solution, a deal that, Vladimir Putin respects him or fears him, and so that it would be different.
Well, Donald Trump makes all sorts of very grandiose statements that don't turn out to be true, and that's certainly one here. Vladimir Putin will certainly not want to enrage Donald Trump, but at the same time, Vladimir Putin has got many of his own objectives, and those objectives have nothing to do with Donald Trump. His main objective is to stay in power until the end of his natural life. In order to do so, he needs foreign enemies, he needs wars, he needs conflict, and he also needs money. And that money will come from extorting foreign businesses, extorting Russian businesses, stealing money from people, as he's always done. And so Russia really is the most hellish country in the world when it comes to integrity in business and any type of normal activity. And anybody who's even considering going into Russia should turn in the other direction. It makes absolutely no sense.
So Bill Browder, thank you so much for joining us today. That was the chief executive and co-founder of Hermitage Capital Management, with some pretty strong words on Russia. Now, Britain's private sector has suffered its biggest contraction in more than 2 years. That's after Donald Trump's tariffs caused orders from abroad to dry up and triggered recession fears, according to a closely watched survey. Now, S&P Global's Purchasing Managers Index tumbled to 48.2 in April, a sharp decline from the previous month. It was worse than the 50.4 reading expected by economists, and anything below the 50 threshold, of course, means it's a sign of contraction. Now, the head of the IMF has warned there's a greater chance of a global recession if uncertainty over trade drags on. Kristalina Georgieva spoke to Bloomberg at the IMF's annual spring meeting in Washington.
If we have this cloud of uncertainty coming lower and lower, making it difficult for the business community and for households to take decisions, we could have a self-inflicted injury that I guarantee you we would regret.
Well, that was the managing director of the IMF, Kristalina Georgieva, speaking to us earlier. Now, there are also plenty more high-profile interviews from the IMF meeting in Washington this week, including with the Bundesbank president, Joachim Nagel, who will be on surveillance today at 12:30 p.m. London time. Now, a ChatGPT executive says OpenAI would be interested in buying Google's Chrome browser if a federal court orders it to be spun off. ChatGPT's head of project was called by the U.S. Justice Department to testify as part of a 3-week trial to determine what changes Alphabet Google's must make after a judge found last year that the company monopolized the search market. And the alternative medicine advocate Deepak Chopra has written dozens of books exploring health and well-being. His latest, Digital Dharma, is his 95th book. Now, it explores the role of technology, and particularly AI, in spirituality. Well, I've been speaking to him about whether he thinks artificial intelligence can actually improve human intelligence.
It expands human intelligence for sure. The big question is, does it expand spiritual intelligence? Can it help us become more self-aware? A machine that is not aware of itself, can it help you become more aware of yourself? So AI has huge implications for not only the future of well-being, the future of what we call health span and longevity, but a deeper understanding of reality. What is consciousness? What is experience? How do we engage in contemplative inquiry to access spiritual intelligence beyond, what we call intellectual intelligence or emotional intelligence, all of which, by the way, AI can help with.
What do you think of artificial general intelligence? In fact, one of the great questions that we have is, what is it exactly, and when do we know if we've hit singularity?
Well, everybody's talking about it. I don't believe that AGI will ever be conscious. Conscious means subjective experience. So it doesn't feel hunger or has sexual urges or fear death or have existential dilemmas or feel thirst or anxiety. So in that way, artificial general intelligence will not be conscious, not have subjective experience. It will simulate that, and that will happen sooner or later.
You're good friends with Sam Altman, because I read you both love meditation.
Yeah.
What do you make of tech chief executives' influence in the White House at the moment?
I think the White House has to be receptive to these great minds that we have right now in the world of technology. And the world of technology can also help solve conflicts. Right now, everywhere in the world, all we see is trying to solve conflicts through violence. So we have medieval minds as leaders in the world, and then we have modern capacities, including AI and nuclear weapons and so on. So I think it behooves any leader right now who wants peace, prosperity, sustainable planet, introduce health, well-being, to be fully versed in AI, or if they're not, they get the right team. Because there's no problem you cannot solve today if you have a shared vision, if you complement each other's strengths, if you have maximum diversity, and you create a spiritual, emotional bond in a team, then we have creative solutions. But we still don't think like that. We have metaphors of violence, the war against war, the war against poverty, the war against cancer. These are ridiculous medieval metaphors that have no place in our modern world. With the capacities that we have, we can actually, and this is a conversation I've had with Sam many times, that if we collectively use AI with a shared vision, we could help create a more peaceful, just, sustainable, healthier, and joyful world.
Well, that was the author, Deepak Chopra, speaking to us from New York. Now, coming up, Elon Musk says he'll spend more time focusing on Tesla over his White House role as the EV maker's profits plunge. That story's next, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
When you're in emerging markets, you are in volatile environments, more so or less so. Structurally speaking, we do still have a very positive view in Mexico. On the macro side, because structurally speaking, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates, it complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, you've seen it grow because structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
BBVA's Chief Financial Officer, Luisa Gomez-Bravo, and Chief Executive Honor Genk, speaking to Bloomberg's Kritik Gupta about the outlook for its largest market, Mexico, in the wake of Trump's tariffs. Now, they both feature on Bloomberg Chief Future Officer, which airs tonight for our U.S. viewers at 9:30 p.m. New York time and Thursday evening in Europe. Now, Elon Musk is vowing to devote more time to Tesla starting next month. He says his stint leading the so-called Department of Government Efficiency will be largely complete. Now, investors have taken Musk's decision to focus on the EV maker as a positive move. This comes after Tesla reported first quarter results that missed analyst estimates. Joining us now is Craig Trudell, Bloomberg's Global Autos editor. So, first of all, Craig, I mean, this kind of came as a surprise, but I don't know whether it's because there are tensions with people in the White House or whether he actually needs to get back to focusing on Tesla.
Yeah, I think it may be a little bit of everything here at play where, all along it was the case that, as a special government employee, he had a sort of ticking clock that he was subject to. I think he's also, acknowledging that this is not working in, coming right out and beginning the call with this idea that he's going to devote more time to Tesla. But I think it's also important that we note that, last night he said as long as Trump wants him for, the length of his presidency to help out, he's going to help out, and maybe even, a day or two a week. So he's not going anywhere. He also was not, in any way sort of contrite or apologetic. He, said his critics are on the take and are paid protesters, that sort of thing. So he's not necessarily sending a signal that, I'm going to try and, make amends or rethink my actions. He was very much of the mind of, I'm in the right here.
Greg, what does he now need to do to put Tesla back on track?
I think importantly, he needs more affordable vehicles to sell. And so that was one of the things last night that, for all of these numbers being quite weak and even weaker than expectations, their sort of assurance that these more affordable vehicles that they've said will be coming in the first half of the year are still on schedule. There was some real concern about that because of a Reuters report on Friday. They seem to bat that back, although they also didn't come right out and say that was, wrong. And so, they also acknowledged that there may be that ramp is not maybe going as quickly as they would like. So I think it's important that they do follow through on that, because this is a company that, the sales weakness is substantial on the automotive side. And another sort of key bit of news to come out of last night was the energy business, which has been extremely strong, is more susceptible to tariffs, hitting that side of the business, because they have been importing battery cells from China into the U.S. for that business.
Craig, thank you so much. As always, you have a good sector to follow, especially with a lot of big personalities. Craig Trudell, they're our Global Autos editor. Now, SAP's first quarter profit actually beat analyst estimates, even as its closely watched cloud software revenue came in slightly below projections. Now, the chief executive, Christian Klein, told Bloomberg business is strong, despite worries that U.S. tariffs could trigger a global slowdown.
No pullback on spending on SAP. I mean, obviously, what they are telling me is, Christian, help me to, drive productivity. Give me more AI on asset management, on supply chain. How can I automate several tasks in my back office functions? I mean, that is, of course, what they are now more and more asking for, given, that they are under financial pressure. But what we are not seeing yet is that they are actually delaying projects or even cutting projects.
Well, Bloomberg's Charlie Wells is now here. So, Charlie, SAP's share price jumping on the back of the earnings report. So what do investors like?
So the markets are loving this. That share price is up by the most at one point this morning since 2019. And, Deutsche Bank analysts called SAP a masterclass in resilience. And what investors really seem to be liking is the fact that the business model here could withstand a lot of this tariff uncertainty because of the business that they will be booking. The contracts that they've already entered in could give them a lot of insulation in tariff uncertainty going forward. And the margins here have improved 250 basis points. So they came in 250 basis points ahead of consensus.
Yeah, that's really quite impressive. Now, did SAP give a broader read on how, it could all be affecting, how tariffs could affect tech?
Well, Francine, a framework on tech is starting to emerge as we get deeper into earnings season. And what we're seeing is firms that can get that insulation, that have this kind of booked business, those are probably going to benefit in the market. I think some tech firms that might take a little bit more of a hit, might be more dependent on headcount at some of their clients or might be more dependent on consulting. SAP, not really in that bucket.
Elsewhere in tech, Bloomberg has also learned Intel plans to cut more than 20% of its staff. What more do we know?
These are huge cuts, and a person familiar with the matter said that they could be announced this week. And this will be the first major reorganization coming from the new CEO, Lip Bhutan, who took over the company last month. And he has been trying to reorient this company as they've ceded a lot of ground to competitors. This seems like some of his strategies starting to emerge now.
I know we're knee-deep into earnings. Intel's tomorrow.
It's tomorrow, and I think that strategy is what analysts are really going to be looking out for. We've got a new CEO. Is the strategy cut, cut, cut? Is it something else? Is it reorient? I think that's what's going to be on the docket tomorrow in their report.
There's a lot going on. Charlie, thank you so much for bringing us up to date with some of the earnings to come and the ones that have been. Now, also, don't miss our interview with the Bundesbank President, Joachim Nagel, at the IMF's spring meetings in Washington. That interview at 12:30 p.m. London time today. Now, if you look at the markets, let's give you actually a market update because there's just quite a lot going on. First of all, we're seeing the stocks definitely, breathing a sigh of relief, stocks jumping. Futures in the U.S., but also European equities jumping, bonds rising. There's a lot of relief across global markets after the Trump administration diffused some of the tensions that have rattled investors. Two main things. The president, Donald Trump, says he does not plan to fire Jay Powell, and there's a lot of growing optimism of easing U.S.-China trade tensions, and that really is boosting the mood. Now, Trump saying that he plans to be very nice to China in any talks and that tariffs will drop if the two countries can reach a deal. You can see that also playing across European markets with the DAX getting some 3%. Up next, Bloomberg Brief. This is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
We're micro investors. So as micro investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services companies. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself. But in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. The walk back relief rally, stocks and bonds rise as President Trump tries to diffuse tensions over Chair Powell and China tariffs. Shifting focus, Elon Musk says that he'll pull back from Doge to concentrate on Tesla. Shares rise despite a miss on earnings. And Intel announces plans for a significant job cut this week. More on that Bloomberg scoop coming up. It is another pivot rally this morning. We are up more than 2% across the board for these future indices. The NASDAQ 100 up nearly 2.5%. We are now down only about 5.5% for Liberation Day. We're flat from Trump's Powell termination Truth Social tweet. The Treasury Secretary yesterday at a private event suggesting that the standoff with China is unsustainable. Expect de-escalation. Trump later echoes that, and Trump says no intention of firing Powell. So this is the picture you get. Stocks rally, dollar rally, although I should say that rally is starting to peter out on the dollar, but spreads tighten and duration rallies too. Let's take a look at your bond market because that continues. Your 30-year yield down by 8 basis points. It is a long end leading the rally yesterday. 2-year yields were a bit softer. We're unchanged this morning. Your 10-year lower by 6 basis points at 434. We will get an auction of 5 years today. And gold, you can see, takes a breather from the record high after posting 22 record highs so far this year. Gold's weaker this morning by 1 3/4%. Let's take a look at some of the stocks moving this morning in the pre-market. Here with that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So Tesla, the real focus today. Take a look where we're trading at the moment. We're up around 6% now. The earnings looking a little bit light, but most of the focus on Trump or Musk. Getting my two mixed up there. Musk saying he's going to potentially step back from his role with Doge. So that is the positivity. Trump in the headlines so much I can't stop thinking about him today. But then we've also got Intel announcing potentially 20% job cuts across the business. The new CEO there is wasting no time in ringing the changes after coming in just a month ago. Intel gaining 3% on the potential boost to the efficiency in that one. And then one stock sliding is Halliburton, saying that a lot has changed over the past few weeks in terms of the tariff outlook. That stock was a little bit lower. I'm having a shocker today. That was lower before I headed over. It's actually higher now. They have downgraded some of their forecasts. Keep an eye on that one as the trading day progresses.
Yeah, Joe, I mean, things can change in an instant in today's markets. I think we've come to realize that. Joe, thank you so much. Bloomberg's Joe Easton there with your stocks to watch. And in just a few moments, we're going to be catching up with Henry Allen of Deutsche Bank later in the hour, Terry Wiseman of Macquarie, and Stephanie Brinley of S&P Global Mobility on those Tesla earnings, which Joe was just talking about. But back to the market, stocks gaining from back-to-back losses at the start of the week after President Trump softened his tone both on Fed Chair Powell and tariffs on China. Henry Allen of Deutsche Bank weighing in on the administration's market rhetoric, writing, quote, "There is still some sort of Trump put in place, and the administration are sensitive to financial turmoil." Indeed, Trump himself commented that the bond market is very tricky, and it's not in the administration's interest for there to be a recession. I'm pleased to say that Henry joins us now, macro strategist at Deutsche Bank. And Henry, I want to be clear, you originally wrote that about the 90-day pause in tariffs, but it could aptly apply to what we heard yesterday from the president. Is this still a market in charge of policy?
Hi, Danny. And yes, I think it is to some extent, because it's clear that over recent days we've kind of found and we're starting to find where that Trump put is. Of course, we first had that 90-day extension in response to all that bond market turmoil. And then over the last 24 hours, directly following the sell-off on Monday, we've had Trump say that he has no intention of firing Fed Chair Jay Powell and has talked about dialing back tariffs on China as well. So I think it's clear that this is an administration that's pretty sensitive to financial turmoil. And even if there might be a higher threshold for that than there was in Trump's first term, they don't have an infinite tolerance for that.
Well, look, there's clearly near-term bullish implications. You can see that even what equity markets did late yesterday and so far this morning. But Henry, what about the medium to long term? Because we're still in a volatile headline environment. Did these type of walkbacks, do they stem the sort of sell America, rotate from the U.S. to rest of world trade?
I think they do to some extent, because firstly, even if this chronic uncertainty persists, I think after about 6 to 9 months, we will just start to get used to it as a fact of life. And I think although some of the American exceptionalism trade was perhaps over-egged at the end of last year, it's worth bearing in mind there's still, a lot of bullish fundamentals if we look to that kind of medium to longer term 5 to 10 year view behind America. I mean, something I was really struck by yesterday was that as the IMF downgraded their growth forecasts, and indeed the US in particular, the US for 2025 and 2026 still had the fastest growing projection in the entire G7. They have growth rates that Europe would still love to have. So I think that if you look at the fundamentals behind the US economy, a lot of those features are still pretty strong.
Well, you've been also writing about, Henry, this divergence in the hard versus the soft data. You could argue we've even seen it in some of these company earnings reports, the fact that the current quarter and the quarter that they're reporting looks strong. But looking ahead, they say, I don't know. Here are the various scenarios that we're laying out. Here's the big range of hit that our earnings could take depending on what tariffs do. How long does it take for that sort of thing to filter into the economy? Do you assume that it does come to fruition at some point, that the hard data at some point catches up to the negative sentiment?
I don't think that's necessarily a given, because I think in response to surveys, it's very easy to say, I think things are terrible, things feel really bad right now, particularly when, as we've had in recent weeks, a lot of negative headlines. I think that hard data is going to be the real test, because actually I remember in 2022, when the Fed were launching into the most aggressive rate hikes in a generation to bring down inflation, the soft data, the surveys, looked a lot worse than the hard data ever got. We didn't have a recession that was predicted by many in the end. So, as I think we look forward to the months ahead, clearly, I think the hard data is likely to turn down. But actually, whether we get the extent of the downturn we see in the surveys right now is still an open question. And I think that's not going to become evident until more May, June time, because already we have seen, even so far this month, some front running in response to the tariffs. And actually, the limited hard data we do have, for instance, the weekly initial jobless claims since Liberation Day, those have actually remained pretty strong so far.
Yeah, I was going to say, I noted down a couple earnings comments. Henry, Capital One, saying that consumers are still solidly in the game. Kimberly Clark saying that they are making no changes when it comes to spending on things like innovation and marketing. Verizon, no major consumer shifts in behavior. Amex, overall spending levels have remained consistent. Is there a degree, though, you mentioned the pull forward because of tariffs, that could be what we're seeing from the consumer in its strength, that they are getting ahead of some of the perceived price increases that could be coming from tariffs?
I think that's definitely going to be a feature, yes. And actually, we're going to have to be pretty careful when we're digesting some of the Q1, some of the April data, and actually even to some extent over May and June, because if consumers believe that after 90 days we've got this extension period, if those tariffs do come into effect after those 90 days, then you could see that pull forward effect perhaps carry on into Q2 to some extent. So the real test is going to be, can Trump signal or perhaps even achieve some of those trade deals he's talked about with other nations? Do markets and consumers start to see signs that those tariffs are being dialed back in a durable way, signs that perhaps we're at peak tariff, so to speak? And if we do, then I think there's every possibility that the consumer, yes, there's going to be a hit to some extent, but I think the consumer can ride through that without a recession. I remember, again, back in 2022, the S&P 500 saw a peak to trough decline of 25%. And right now we're down peak to trough about 14%, given where futures are. That would take us up to about 12%. So right now we're only seeing about half of that 2022 decline, which wasn't capable of taking us down to recession, at least as a result of those wealth effects. So I think, the market so far isn't pricing that recession in fully. We're not seeing, across a range of asset classes, across equity declines, across credit spreads, in oil prices, we're not seeing those recession-like declines that you would expect if people did think we were going to have a recession.
Well, Henry, I have to say, you sound quite bullish, all things considered, in this environment. But I have to wonder, paradigm shifts, they take not just a couple of days to happen, but months, if not years. Is there a scenario where we don't get a recession? There's no crash, there's no financial crisis, but the U.S. just kind of muddles along, and the actions that we've seen from this administration slowly erode things. Is that a scenario you hold on to, or can we really get back to normal, and that this isn't a time of paradigm shift?
I think, the big test will be over the kind of coming weeks and months, because, I know we've heard a lot about the potential for the US dollar to lose its reserve currency status, but given how many legal contracts that's wired into, that process, as we saw for the pound sterling a century ago, can take a very, very, very long time. And one thing I'm conscious of, amidst all the political events in the United States, I remember in the early 2010s, around the debt ceiling crisis of 2011, and then you had the fiscal cliff in 2013, there was this narrative that the US was losing its edge, that growth was slower after 2008, that political gridlock was going to get in the way of continued market exceptionalism. But actually, the S&P did very, very well in that environment, at least on a longer term time frame, looking out over a 5 or 10-year horizon. So political gridlock by itself is not enough, we've seen historically, to take markets down. If anything, actually, markets are pretty resilient against geopolitics. I think the big question will be, do the tariffs have a macroeconomic impact? And actually there, the administration have shown that when it has started to have an impact on the markets, and we may see it have an impact on consumer prices shortly, they are willing to dial that back. So I think there are quite a few natural corrective mechanisms that would mean, even if we do see a downturn, the administration's incentives and their policy tools will prevent that from being a particularly sharp one.
Henry, it is such a pleasure to have you on. Unfortunately, that's all we have time for. We could do this all day. Henry Allen of Deutsche Bank, please come and join us again soon. Let's get you some other top stories now that are trending on the terminal this morning. Janus Henderson weighing a 10% cut to its exposure to U.S. assets following the trade turmoil. The firm's CEO told Bloomberg that he could see a tenth of client exposure reallocation from the U.S. to Europe, China, the Middle East, or Latin America. The admission underscores a growing shift away from the world's largest financial market. Cantor Fitzgerald, Tether, and SoftBank are in talks to form a $3 billion crypto firm. Bloomberg sources reveal that the deal is expected to be announced in the coming days. Cantor formed a SPAC in January, raising $200 million to create a new firm. Tether will contribute $1.5 billion in Bitcoin, while SoftBank plans to put in $900 million. Vice President J.D. Vance says it's time for Russia and Ukraine to say yes to the U.S.'s latest proposal for peace, or else the U.S. will walk away from the process. Speaking to reporters in India, Vance said territory concessions from both sides would be needed for a deal between Kyiv and Moscow, with new lines being drawn close to where the current front line is in the war. Coming up, playing nice with China. President Trump possibly softening his stance on the country. If they make a trade deal, tariffs will be somewhere between 0 and 145%. We're going to discuss and give you the details next.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Say, oh, I'm going to play hardball with China. I'm going to play hardball with you, President Xi. No. We're going to be very nice. They're going to be very nice, and we'll see what happens. But ultimately, they have to make a deal because otherwise they're not going to be able to deal in the United States. And we want them involved.
Can you call it a walk back? President Trump potentially softening his stance and cutting China's tariffs, what he says will substantially be from 145%. Where that will be, we're not certain, but if they are able to make a trade deal. The POTUS is saying that levies will, quote, come down substantially, but it won't be zero. So the range we now have is somewhere above zero, but below 145%. Joining us now for more is Bloomberg trade czar Brendan Murray. And Brendan, the conversation we've had here is just from the Trump team side. Do we know anything as to whether China's actually involved in conversations, or are we witnessing a U.S. that's negotiating with itself?
Yeah, exactly. So these are some of the most conciliatory comments that we've heard from Washington. We heard from Trump. We also heard from Treasury Secretary Scott Bessent. And remember, up until now, we've had nothing but escalating rhetoric, escalating tariffs. So what we're seeing, it seems to be, is the Trump administration saying, look, our hardball tactics aren't working. We're not getting anywhere with China and trying to get negotiations underway. So maybe let's tone things down a bit and see if that helps. You know, the flip side of that is it's going to take a lot more than happy talk to get the Chinese to come to the negotiating table. They are facing 145% tariffs on all their exports to the U.S., or most of their exports to the U.S. So there's a lot of economic dislocation going on in China right now, and they're going to want to see, Beijing is going to want to see some pledges that those tariffs are going to come down and not just talk of them happening. They want to see some action.
Raises the question who actually has the upper hand if the U.S. is being dictated by markets. Brendan, you mentioned the Treasury Secretary's comments. I mean, we should point out they weren't public comments. They were behind closed door to J.P. Morgan bankers. But at the same time, his unsustainable comments was something he said very similar to Anne-Marie Hordern just last week. But does it make clear the fact that we had Scott Bessent talk to Anne-Marie about that, the fact that he said these comments not too long before we heard from the president himself, does it make clear that Scott Bessent does have the president's ear, that he is maybe not in charge, but is a bigger influence when it comes to trade conversations than others in the cabinet?
Yeah, until now, it's basically been whoever's standing in front of the camera dictates the tone of the Trump administration stance toward China. So the tariffs that the U.S. has imposed on China will lead to a decoupling over the longer term. Economists are unanimous about that. What we heard from the Treasury Secretary was that is not the goal. So if the goal is to bring the two sides to the negotiating table, the hardball tactics, as the president referred to them, aren't getting them anywhere. So I think what we're seeing is the more dovish side of the Trump administration's trade team trying to get out in front of this. They're seeing markets fall. They're seeing forecasts for their global economy go down. So the pressure, the leverage is can work both ways, and China really has time on its side. So I think that the Trump administration is trying to put something together, put something on the fast track here, rather than just kind of have this standstill. This talks basically go nowhere.
Right. I mean, look, if this is capitulation, and we're certainly not saying it is, what does it say for the rest of talks that the administration has to undergo with various countries? Brendan, much more to discuss with you. Thank you so much for joining this morning, Bloomberg's Brendan Murray. Coming up, Intel is said to be cutting 20% of its staff. A Bloomberg scoop. We're going to bring you the details of what's going on at the tech player. That's coming up next on your Bloomberg Brief.
case you missed it, on Bloomberg Crypto.
You have sell-side analysts taking a look at what you're doing and starting to compare you to Coinbase. Are you after their business?
Well, I think we compete in the general sense of offering crypto to customers, but also this is a nascent industry and not very many companies have entered yet. Even though Bitcoin has now been around for 15 years, institutions and other companies have been waiting for signals to enter the market.
There are a lot of financial firms that are looking to tokenize private funds also.
Yeah.
Are you in talks with any of them?
We're generally in conversations with anyone trying to do interesting things in the space. If I had to pick the biggest pain point, AI is like transforming everything. So I think it's tough right now if you want to be in the AI sector as a retail investor. There's relatively few options that you can actually invest in.
Don't miss Bloomberg Crypto live Tuesdays.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Let's take a look at what the front pages are running with this morning. First up, on the Washington Post, they're leading with Trump's inner circle weighing whether the White House should push for higher taxes on millionaires. The Post reporting that the Vice President and Budget Director, Russell Vought, have expressed an openness to the idea, despite a chilly reception, as you'd imagine, among Republicans on the Hill. Next up, the Journal has this, reporting that America's elite universities are raising cash. Princeton, Northwestern, and Harvard have all issued hundreds of millions of dollars worth of bonds. Yale, meanwhile, is trying to sell billions in its private equity holdings, that off the back of a funding freeze from the Trump administration on some colleges. Finally, the FT reporting that Russian President Vladimir Putin has offered to halt his invasion of Ukraine along the current front line. 3 FT sources say that Putin has told that U.S. Special Envoy Steve Witkoff that Moscow could let go of its claim to areas of 4 partially occupied Ukrainian regions. Now, one of our other top stories this morning, let's get a check on Intel shares because they are moving higher by 3.4% in the pre-market. The chip maker set to announce a larger than 20% cut to its staff. That, according to Bloomberg sources. Let's now bring in Bloomberg's Charlie Wells, who joins us for more. Charlie, what do we know?
Yeah, Danny, so we know that this is a significant cut, and this is the first major reorganization under the tenure of Lip Bhutan, the new CEO of Intel, who was named just last month. And this is going to be something of an indication of how Tan may try to turn Intel around. That's been what he's been tasked with at this struggling chip maker, which has certainly lost ground to the likes of NVIDIA, as they've taken a lot of ground in the artificial intelligence front. And Intel has also lost a lot in the personal computing space as well. So this could be a sign that Tan doesn't have a lot of options and needs to cut. Staff at the end of 2024 stood at about 109,000 employees, and this follows cuts that were attempted in 2024 of about 15,000 people.
Beyond just staff cuts, Charlie, do we understand that other changes that Lip Bhutan is trying to make at Intel?
What we know is that he's trying to streamline the business and return to a lot of those core values. And so the person familiar with the matter told Bloomberg that this was in line with trying to get back to that engineering culture. Tan has also indicated that he is willing to strip away parts of the business that are just not mission critical. So we heard about a sale to Silver Lake of one of these business units last week of 51%, and trying to kind of strip away some of these units that just are not kind of core to the functionality. And that seems to be a kind of two-pronged approach, cutting staff, but also business units that just aren't performing in the same way, that are not central to the way that Tan is going to need to reorient the business. Now, he's going to probably give an indication of a little bit more of his strategy on earnings tomorrow, and those will hopefully give a little bit more clarity on what's happening in the business.
Yeah, that's going to be a must-watch and must-listen to Intel reporting after the market close tomorrow. Charlie, thank you so much. Bloomberg's Charlie Wells. A quick check on markets as we head into the break. It's not just Intel rallying, it is stocks in general. After Trump walking back his comments on Powell and saying that they're going to play nice with China, but is the U.S. negotiating with itself? You can see there across the board, equity is higher, but interesting development in the dollar initially strengthening off the back of that result. That gain starting to peter out this morning, and we're going to discuss just that coming up. Another Trump pivot sparks a market pivot, more on the dollar relief, and if it can come back, we're going to catch up with Macquarie's Terry Wiseman. That's coming up next on your Bloomberg Brief.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. The walk-back relief rally, stocks and bonds rise as President Trump tries to diffuse tensions over Chair Powell and China tariffs. Shifting focus, Elon Musk says that he'll pull back from Doge to concentrate on Tesla. Shares rise despite a big earnings miss. And Intel plans to announce a significant job cut this week. We're going to have more on that Bloomberg scoop throughout the show. And it is a rally, at least in this equity market. It's pretty sizable, up more than 2% in the pre-market trade, up nearly 2.5% for your NASDAQ 100 futures. We're now down only about 5% from Liberation Day. We're flat from Trump's Powell termination tweet. This all started out with comments from Treasury Secretary Scott Bessent behind closed doors at JP Morgan, followed on by Trump echoing that sentiment that they would be nice to China and that tariffs would fall. Meanwhile, stocks rally, the dollar rallies, that's starting to ease a little bit. Spreads tighten in corporate bonds and duration rallies. The 30-year yield was down some 9 basis points in the past 2 days. We add weight to that. We're down by nearly 9 basis points this morning. 4.78 is where you stand on your 30-year yield. Your 10-year yield lower by 5. Your 2-year yield, little change this morning. By the way, gold taking a breather after posting 22 record highs. Let's take a look at some stocks that are also on the move this morning in the pre-market. With that is Bloomberg's Joe Easton. Good morning, Joe.
So Tesla, Danny, really the star of the show this morning. The stock jumping as Musk indicates that he's going to step back from some of his Doge work, really taking the emphasis away from earnings that were pretty light. So Tesla gaining around 6% in the early pre-market trading. Bear in mind the stock coming into this report down around 40% year to date, so really just rebounding. Then Intel, the new CEO, wasting no time and announcing job cuts. Potentially 20% of the workforce could be cut, and that boosting the stock in terms of potentially some cost efficiency benefits for that one, so that one gaining as well. And then finally, Bristol Myers Squibb missing the primary endpoint on a schizophrenia drug, the words that no pharmaceutical investor wants to see in a statement, and that stock down almost 3% in the early trading. Keep an eye on Bristol Myers as we head towards the open in New York.
Joe, appreciate it. Great work as always. Bloomberg's Joe Easton. Now let's take a look on the dollar because it's been under pressure for much of 2025. On Monday, the DXY fell to its cheapest level since 2022, falling against basically all of its major peers in that trading session. Yesterday, on yet again that Trump pivot, you do get some strength coming from the dollar, this time that pivot happening on China tariffs and the fireability, if you will, of Fed Chair Powell. But I will say some of those gains seem to be fading this morning. Joining us now is Terry Wiseman, Director of Global Currencies and Interest Rate Strategy at Macquarie. Terry, great to see you this morning.
Good morning,
Look,
Danny.
risk assets clearly taking a lot of comfort in this. I wonder what you make of the fact that it doesn't seem to be an equal reaction across asset classes, and you even have the dollar this morning resuming some of its weakening.
Yeah, no, that's a very interesting point. We've got stocks rallying and the dollar's barely making a move here since the overnight session. I can't make that much of it. I think ultimately things do align with respect to what the prevailing narrative is. So if the prevailing narrative, of course, is that we're going to walk back, the U.S. is going to walk back from the very aggressive tariff situation that the president has imposed, I have a suspicion that the dollar will rally because remember, the weakness in the dollar that we've seen in the first quarter was really a result of the feeling or the perception that U.S. institutions were failing and didn't have any integrity anymore, and tariffs were a big part of that. So I think the dollar would rally if tariffs were to be walked back. I think the stock market would rally too, and I think that's the alignment that at least the stock market is looking for this morning.
So that narrative, the concern about integrity, about America's financial institutions, even if Trump let's say he completely capitulates on tariffs, does that narrative go away?
I don't think so. Tariffs is only one aspect of what is needed for the financial markets to be comfortable and feel secure in the knowledge that American institutions have integrity and are stable and are enduring. What's happening with the Fed and Fed independence is another institution. What's happening with the fiscal situation and the nature and contours of who runs the executive branch are another issue. Whether Congress can act as a effective check and balance on the White House is another institution in the United States. I think that tariffs is only one issue, and even if we resolve the tariff issue and get some clarity, I think that foreign investors, but also U.S. investors to some extent, have lost faith in U.S. institutions semi-permanently. This may endure at least until we get to the end of this Trump administration.
Does it go so far as to say, especially when you look at what's happening with duration, the fact that yields have been led higher by real rates, it's not necessarily inflation concerns, that there's an element that along this trajectory is one where you start to lose that exorbitant privilege that America has to spend, that people will keep funding our twin deficits. Does that come under threat too?
Oh, absolutely. One of the interesting things about the U.S. Treasury market and the U.S. Treasury is that effectively it serves as the prime broker for the rest of the world. People feel comfortable holding Treasury securities because they could be used as collateral. They're taken as good collateral just about everywhere. And if people have lost faith in the ability of the U.S. to honor its obligations, that aspect of the U.S. Treasury market, but also indirectly of the dollar itself, will fade and be lost and start to crumble. So I am concerned, and I'm concerned specifically that you might see the rating agencies, Moody's, for example, downgrade or issue a warning on U.S. debt if we continue to see this continuous chipping away at the integrity of U.S. institutions.
Well, it's interesting because you're not describing a recession, you're not describing a shock. It's more this slow grind of change. And paradigm shifts take a really long time to happen. How do you even begin to imagine what that looks like 5 years' time, 10 years' time? How do you think about that?
Yeah, well, if what I'm thinking and what I'm suggesting indoors, we're going to be living in a world where it's going to be much harder for the U.S. Treasury to finance its deficits. Now, there may be incredible amount of political pressure to reduce those deficits as a result, and that might be actually a good thing that comes out of this pressure, that we're finally resolved to do something about it. I also see the prospect that the dollar will be structurally weakened. Another way of saying this is that the era or the narrative of American exceptionalism that we enjoyed in the fourth quarter of last year and the beginning of the first quarter of this year is likely not going to recur. I do not see a situation again where there's that much enthusiasm around the U.S. growth and the U.S. dollar again in the next few years.
So if we don't have that enthusiasm, we have troubled relations, international relations. Again, let's play with the scenario that Trump does walk back to a large degree these tariffs. How do you think about where the 10-year yield should be?
Well, I think to the extent that there has been an impulse or an effort on the part of investors to get out of the dollar and to get out of treasuries, it's a little bit overdone. You could see that with respect to, by just looking at the speculative positioning of traders and the CFTC reports, the speculative length is extended in the yen, in the euro, in foreign bonds, sovereign bonds like bonds, for example. So technically speaking, there's a little bit of overselling of the dollar, overselling of treasuries, and that could ratchet back. But that's really a short-term argument. It's an argument based on technicals. It's not really an argument about the structure of the U.S. economy and the U.S.'s financial sector 5 years out. 5 years out, if we do not see a change in the direction of U.S. institutions and the perception of those institutions, we're still looking at a world in which the dollar is weaker and U.S. Treasury yields are a bit higher than they otherwise would be.
Well, speaking of things that are a little bit more short-term, we have some auctions to get through. We have a 5-year today, a week, 2-year auction yesterday. How do you juxtapose that with what has been strong demand in longer duration auctions we've gotten as of late?
Well, it's interesting. I think you have to balance two things here. One, of course, is that we presumably are seeing a lack of demand for dollar and dollar assets from investors abroad because all of a sudden they feel more secure in their own currencies and in their own bond market. At the same time, there is a lot of concern about recession in the U.S. and the prospect that these tariffs, by taking spending power away for the consumer, are going to cause a major slowdown in the U.S. This quarter and the next quarter. Now, it has been the case that in every recession since the end of World War II, with the exception of one, which was the recession in 1973, 1974, 10-year yields have fallen. So there is the pressure of buying the 10-year from the presumption that you want to get out of risk assets and go into something that's a little bit safer. At the same time, there's the pressure to get out of U.S. assets, generally including treasuries, from U.S. investors and foreign investors who feel less comfort with the U.S. and the U.S. dollar.
Terry, this has been so fascinating. Thank you so much for coming and joining this morning. Really fantastic to have you on. That is Terry Weissman of Macquarie. Okay, let's get you some other top stories now that are trending on the terminal. Speaking of rotating out of the U.S., Janice Henderson is weighing a 10% cut to its exposure to U.S. assets following trade turmoil. The firm's CEO told Bloomberg that he could see a tenth of clients' exposure reallocated from the U.S. to Europe, China, the Middle East, or Latin America. The admission underscores a growing shift away from the world's largest financial market. Cantor Fitzgerald, Tether, and SoftBank in talks to form a $3 billion crypto firm. Bloomberg sources reveal that the deal is expected to be announced in the coming days. Cantor formed a SPAC in January, raising $200 million to create a new firm. Tether will contribute $1.5 billion in Bitcoin, while SoftBank plans to put $900 million in. Vice President J.D. Vance says that it's time for Russia and Ukraine to say yes to the U.S.'s latest proposal for peace, or else America will walk away from the process. Speaking to reporters in India, Vance said territory concessions from both sides would be needed for a deal between Kyiv and Moscow, with new lines being drawn close to where the current front line is in the war. Coming up, shares of Tesla getting an extra boost this morning, rally in the pre-market. Elon Musk signals that he'll focus more on the firm. We're going to have more on that with Stephanie Brinley of S&P Auto Intelligence. That's coming up next.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
In case you missed it on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up, if you could stay 8 seconds.
I know, this sounds awesome. Do I have to go I don't want to go to rodeo for that. That's
No, you could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close, live every weekday. Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Starting probably in next month, May, my time allocation to Doge will drop significantly. I'll have to continue doing it for, I think, probably the remainder of the president's term, just to make sure that the waste and fraud that we stop does not come roaring back.
Musk comments there on taking a step back from Doge, overshadowing Tesla's latest earnings miss. You saw their shares in the pre-market up more than 6% this morning. He said he would refocus his time to the car company, which is struggling under the weight of slumping sales and rising costs from President Trump's trade war. Joining us now is Stephanie Brinley, Associate Director of Auto Intelligence at S&P Global Mobility. Stephanie, thanks so much for joining this morning. Let's put those comments to the side for just a moment, which clearly are impacting equity prices. I want to ask you about the earnings themselves, because we saw a miss on multiple fronts. What was your takeaway from them?
Well, with lower sales and higher costs, then you've got a margin impact.
And we could see it coming in the sense that the sales had been down earlier in the quarter. It's to be expected, but they did still manage to squeeze out a profit. You're looking at operating margin of 2.1%, though. That's not strong in automotive for sure. And automotive is still a tight area. They did manage to do a 14.6 adjusted EBIT margin, so that was a little bit stronger. I also think it was interesting that their sales and deliveries of what they call other models, which includes the Cybertruck, were also down. And we've been looking at Cybertruck sales slipping quarter over quarter, month over month. They've been coming back down. So it does not seem like Cybertruck has been the knockout hit that they'd hoped it would be.
I mean, not only is it down, Stephanie, I was looking at the numbers. Cybertruck deliveries down a whopping 24%. Are we going to look back on the Cybertruck as a boondoggle? Is there reviving the sales of this monster of a car?
That remains to be seen. It seems like it's a difficult step. Now they are coming up with a long range version at $63,000 after incentives, so that could make a difference. And one of the things that they did note is that the Model Y and the Model 3 are now using U.S. source batteries in the U.S., so they should be eligible for more incentives. And the full range would be eligible for incentives as long as we have them. Of course, we don't know for sure how long we're going to have those, but as long as we have those, the Cybertruck is going to be an interesting one to keep watching. The lower price point could help. They did also mention that it would be shipping to Saudi Arabia this quarter as well, which would be the first international market for Cybertruck.
I was looking through the comments also in the earnings. One of the things they said, absent from macro issues, we aren't seeing any reduction in demand. I'm not really sure what that means, macro issues, Stephanie. And also for other automakers, we've seen this pull forward of people wanting to get out and purchase things. Is there a concern of brand reputation in Tesla? Could that be some of quote unquote macro issues, that they're just kind of lumping in everything and maybe using that as a scapegoat as to why sales look weaker?
It could be. I think that it's still trying to figure out exactly how much was what they refer to as bad brand image, or how much has to do with an older vehicle lineup. I mean, of course, over in the first quarter, they freshened the Model Y just a little bit, but the freshening of the Model 3 a year earlier hasn't seemed to move the needle, and maybe it won't. The products themselves are getting a little bit older, with the exception of the Cybertruck, and the competition is getting more fierce. And macroeconomics are playing a role in there. We do see sales coming down, and with the tariffs coming into effect, the rest of 2025 could look pretty bad all the way around. In the U.S., S&P Global Mobility's light vehicle sales forecast took our expectations for the U.S. market down to about 643,000 units for the rest of 2025 based on the tariff impact. And that'll affect Tesla as well. That's going to affect everyone.
So we have Elon Musk saying that he's going to start refocusing on Tesla away from Doge. Stephanie, how much confidence does that give you?
I'm not sure, actually. I mean, because I don't know that that's fundamentally the problem. If you've got an aging product lineup and some other issues coming into play, it may be more about product than it is about Musk, which is interesting to say, and the fact that he's overshadowed so much. But his attention being focused more on Tesla seems to, by the reaction of Wall Street, seems to affect Wall Street more so than it does the day-to-day operations of the company. Simply being in the office more days per week doesn't necessarily mean you've got a new buyer.
Stephanie, that's so fascinating. So just in the final minute here, what is the formula for success to overcome some of the issues that they're seeing?
You know, part of it will be if they do introduce the new, more affordable vehicle, what the reception is to that is going to be key. They have a small range, a small lineup, and they have a lot of competition. So some of it is going to really be, can they turn around the profitability in the future quarters? That in some ways is more important than the volume. We know volume is going to be challenged globally. We know volume is going to be challenged for most automakers over the rest of this year and all of next. In that environment, it might not be sales in and of themselves. It may have to do with profitability and cost. And adding an affordable model can make a difference still. With only a couple of cars, product is still king. and product is still where people are coming from, and competition is fierce. They need more product.
Yeah, Stephanie, again, it's such a fascinating view, given we've heard from other analysts saying that the formula for success is Elon Musk coming back. So a very timely commentary from you. Stephanie, thank you so much for joining us. Stephanie Brinley of S&P Global Mobility. Some breaking news to bring you. Apple, Meta, they have been fined by a total of about 700 million euros, or just under $800 million, by the EU for breaching tech rules. Those fines, I have to say, they're coming in even though we heard the US President Trump warn of retaliation should the EU impose these fines. The breakdown, 500 million euros for Apple, 200 million euros for Meta, but those are a much lower figure than we had seen for prior penalties. Perhaps we can speculate that this is an attempt to still fine them, but avoid some of the most extreme of Trump's ire. So again, Apple and Meta getting a fine from the EU. Let's now move on to other earnings. We're going to get Boeing reporting before the market open. Analysts are expecting to see an improvement after a string of heavy losses. Now, the focus in particular will be on what the plane maker says about navigating turbulence. For more, we are joined by Bloomberg's Benedict Camel, who leads our global aviation coverage. Benny, what are we expecting for the earnings today?
So overall, the picture is looking a little better for Boeing on an operational side. They have, under the new CEO, Kelly Ortberg, they've improved sort of the factory processes, so planes that are coming out in better condition, less repair work that's needed. They're coming out at a faster clip. The recent monthly deliveries have actually ticked up a bit. So all of those things actually look quite good. But then you have the tariffs and the macro environment that is sort of going the other way. So that's going to be one big thing that investors and analysts will be looking at, sort of how does Boeing navigate that? Will the progress that the company has been making, will that be undercut, maybe even sabotaged by the macroeconomic developments? We've heard that China, in particular, has stopped taking Boeing aircraft, and that's obviously a huge market. It's the second biggest aviation market after the US. So that's something that people will be looking out for. How will Boeing navigate that? Can they find other markets? India comes to mind. The good news for them is that they have a lot of demand for their products. So being able to mitigate what's going on in China and the broader economic fallout, that's going to be a big theme of the earnings that hit in a couple of hours.
Benny, I got to ask then, what did you make of GE Aerospace yesterday? Basically giving an unchanged to their outlook, saying demand is still there, a crucial component for many of these plane makers when it comes to engines. Does that maybe set expectations a little bit higher for someone like Boeing today?
Yeah, the demand picture is still quite strong, but this is the here and now, and we'll have to see how this plays out in the next couple of months. We have heard anecdotally from a number of airlines that say that, in particular on the transatlantic route, things are looking a little bit softer. We heard from Virgin Atlantic, for instance, just today, Richard Branson, the founder, saying that things aren't looking that great. So once that seeps into the wider market and into the manufacturing side, that positive picture might change fairly quickly.
Benny, thank you so much. Bloomberg's Benedict Camel there on Boeing earnings. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Let's get you set up for your trading day on this Wednesday. Boeing will be reporting earnings before the bell, IBM after the market closed. Then a lot of Fed speak, Goolsbee, Musalem, Waller, Hammock, and Kugler all throughout the day. Plus U.S. PMI data that comes out at 9:45 a.m. Eastern. A quick look at some stocks on the move. Intel, those shares are rallying in the pre-market. Bloomberg sources saying they're going to cut 20% of staff. Tesla earnings there. Elon Musk says that he's going to refocus on the company, put aside the poor showing from the earnings themselves. That stock is rallying. Finally, Emphas Energy, one of the few stocks in the red this morning, down more than 10% after a Morgan Stanley downgrade. All right, that is it for your Bloomberg Brief this morning. Surveillance will take things from here. This is Bloomberg.
We'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
From politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Clearly, we've seen an unwind in sentiment around U.S. exceptionalism.
Every day, it seems there are more and more reasons to pare back what's been an overweight position across U.S. assets.
We think that growth estimates are still too high. This market hasn't fully calibrated to a lower growth world.
We haven't priced in really a recession. We haven't priced in a meaningful decline in earnings.
In terms of the hard data, it's going to soften. Earnings data is going to soften as well.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
What a 24 hours live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday with the president striking a conciliatory tone.
We're doing fine with China. We're going to be very nice. They're going to be very nice. And we'll see what happens. But ultimately, they have to make a deal.
You have no intention of firing Ron Powell?
No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates. But no, I have no intention to fire him.
Music to the market's ears. Trump backing away from fiery rhetoric on Powell and teeing up lower trade tariffs on China, fueling hopes for some kind of an agreement, just as the IMF slashes its global growth outlook and companies begin to complain about higher costs. From Kimberly-Clark to GE, corporate America flagging additional price pressure across the supply chain. For them, some relief can't come soon enough.
And we are getting this relief, and it's coming from Washington, D.C. This is what consumers, corporate America, investors have been thirsty for. On 2 fronts, we do see Trump really striking this conciliatory tone, this pause, if you'd say. One, on Powell. He's going to keep jawboning him to cut interest rates, but his job is safe, according to the president. And the president said, never did. The press runs away with this, John. It's all our fault. He never had any intention of wanting to oust them. And then on China, he said we're going to be nice. He didn't say it was going to be 0 when it comes to a trade deal, when it comes to tariffs. I don't think anyone was expecting 0, but it's not going to be 145%.
Let's sit on China. We're going to be very nice. They're going to be very nice. We'll see what happens. It will come down substantially. Who is he negotiating with, China or himself?
Well, I think at the moment he is putting out signals for Xi Jinping and the Chinese Communist Party to maybe have an olive branch, reach out and say, we want to set up a call. So at this moment, I see why you think he thinks he's negotiating with himself, because at the moment, China's not picking up the phone.
Can you put the toothpaste back into the tube? A lot of damage has been done. There's plenty of reasons to buy America. Let's be very clear about that. But there has been some damage done. We've heard this from Janice Henderson in the last 24 hours. We can see 10% of our clients' exposure or assets under management reallocated from U.S. assets to abroad. Seeing a similar thing come from Amundi, another asset manager out of Europe. Can you do something to address that?
Exactly. I was wondering about this as well. Is the genie already out of the bottle, no matter what the president says? The original, his gut, his Maximus approach is already out there for the world to pick up on, and you're already seeing those flows move out of the United States. Will they come rushing back in? That's the question.
Equity futures this morning positive by 2 full percentage points. A turnaround in this market continues. Some stability in the bond market at the long end of the curve. Yields are lower by 9 or 10 basis points on a 30-year. That maturity, that yield, 478. Coming up this hour, we'll catch up with Julian Emanuel of Evercore as President Trump backs down. Adam Posen of the Peterson Institute as the clock ticks on trade talks, and Ben Callow of Baird as Elon Musk vows to pull back from Doge, and Tesla in the pre-market is higher by 6.5%. We begin this hour with stocks rising on signs of easing U.S.-China trade tensions. Julian Emanuel of Evercore looking for deals. Our base case is that the lows of this sell-off have been seen and that a recession will be narrowly averted, but the clock is ticking. The art of the deal needs to begin bearing fruit. Julian, good morning.
Good morning.
How exhausting is all of this?
You said 24 hours. It's felt like 24 weeks, basically. Look, we knew this was going to be this way, okay? I think if you go back to January 20th and you saw everything that was done on Inauguration Day, to expect this is par for the course, really. But again, it is the narrative of several weeks ago, there were still questions as to whether the Trump administration was willing to tolerate a recession to achieve some of its aims. What we've seen in the last 24 hours and going back to the pivot in early April is that is absolutely not the case. And removing the large left tail outcome in markets has been very positive.
Rewiring the system is difficult. We've talked about it a few times on this program, that you've got both a shock to the cycle and a potential shock to the system. But what we've also seen and witnessed down in Washington, D.C., is that some of these policies are so extreme, so out there, that they're somewhat self-limiting, that are almost negotiating with themselves on certain issues. Do you get the same sense when you look at what's happening down in Washington?
There is an element to that, and again, it is the the shock to the system. This concept that the all-in raw number to global weighted tariffs is higher than Smoot-Hawley. You don't really need to say much more than that, and that is the element of self-limiting. But again, it goes back to the negotiating style. Throw out the maximalist case out there and then see and wait for the other side to start responding.
And we saw that in Trump's first administration. This is a phrase I don't think the president likes, this idea of a Trump put. But have we now seen that there is a Trump put and there is a level that they are unwilling to deal with?
Well, I wouldn't necessarily call it a put per se, but again, it just goes back to this idea that there's an acknowledgement that the extremity of what they're trying to do and the speed with which they're trying to do it. And remember, all of this is set against a debt ceiling negotiation that has to happen in the next 2 months. And then further on down the line, the acknowledgement that the traditional historical tendency is for the Republicans will lose the House of Representatives in 2026. So you have to front load all of this. So that is the shock to the system. But again, there is no wish for a recession. And so, by that virtue, the Trump put itself does seem to exist south of 5,000 on the index.
John brought up a great point on whether or not they're negotiating with themselves. Maybe the president is going through the motions out loud, but also behind the scenes, there are 2 or 3 different rivals. This is a cast of characters in terms of the cabinet. At this moment, it does look like Scott Bessent, the Treasury Secretary, is leading the charge on a lot of this. Is this rally, is this relief just temporary if Peter Navarro comes back into being one of those driving forces?
Well, if you look at the cast of characters, there are some who are more volatile and some who are less volatile. Secretary Bessent is clearly the lower volatility, the VIX sub 30 type individual, which is what we have this morning. But again, going back to the first Trump administration, that's the way he likes to run it. The court fights amongst itself.
This is the problem, though, Julian. You've touched on it. That's what we have this morning. What do we have tomorrow? You've got a constructive view that goes beyond just 5 minutes. What does the rest of the year bring?
The rest of the year brings progress on the initiatives that have been brought forth. Look, from our point of view, if you think about a timeline, what you're going to get on May 7th from the Fed is we told you we weren't budging, we're waiting to see more data, we have every indication that we don't need to move on interest rates now. So by that virtue, you've actually got to put some tariff points on the board between now and May 7th, more likely. And, it would seem reasonable to expect you'll start to hear better news.
I think this is an important exercise. You've got to try and get your head through summer. Let's get to the end of the summer and look out 12 months. What does that world look like?
We actually have to project that far out, Jonathan. I mean, investing is only a 1-week thing now. No, look, the bottom line here is all of this has been a disruption to the way America does business. No question about that. And what you're hearing from companies now as earnings season gets into full swing is how they're trying to deal with it. But the bottom line is after they're dealing with it, the last 2 years of really being incredibly diligent and responsible about guarding and maintaining margins at the corporate America level means there is going to be an ability to make the transition. And so from our point of view, if you're thinking about the markets, the fact that consensus is looking for 9% earnings growth this year, down from 14, our view is you're still going to get 5, actually means that, the implication is, A, there won't be a recession. which is our base case. But B, for equity markets, that's fine. That's his quote-unquote transition period.
What would make you change your mind and think the U.S. could tip into a recession?
The data would have to start rolling over severely. You know, and look, we do think the data is going to moderate. But again, it goes back to this idea that what we have seen post-pandemic is a different world pre-pandemic. So the sentiment data has been absolutely abysmal, but it really hasn't had any material effect on the hard data. If that is no longer the case and we switch back to a pre-pandemic relationship, which we don't see, and that's why everyone is so much on pins and needles, particularly for the May 2nd employment report, and then the weekly jobless data, that's a different set of circumstances. We just don't see that right now.
We're already seeing the data be distorted, though, flattered by some pull forward. We saw that in retail sales, particularly auto purchases, which I find amazing. You're worried about the economy, so you go out and buy a car. America, that's where we are. I want to understand what the rest of the summer brings. Once you pull forward activity, are we going to hit some air pockets in the next few months?
I think there will be, and if you go back to that last inflation report, which was softer than expected, is that a lot of the distortion was by a decline in price in used cars because people were buying new cars in front of the tariffs. So I think, again, this is one of these things in this higher volatility environment, we're living with the data being distorted, but if the overall trend remains intact, you know, our assumption is we're going to be able to get through this without a recession.
So let's pick up the pieces. We've done a lot of damage, not just at the index level, but beneath the index, we've seen some real damage to some big tech names, some high flyers of the last several years. As you look at picking up the pieces, what do you like this morning?
We actually are of the view, and this is typical in when bear markets end, is that the things that got sold off the hardest, which in this case were the bull market leaders of the prior 2 years, are going to resume the mantle. Call it Mag 7, call it whatever you want, but the fact is that part of the U.S. markets, a large part of the U.S. markets' outperformance has been driven by technology, and for us, that is a story that has further to run.
Alphabet earnings 24 hours away. Julian, it's good to see you, sir, as always. Julian Emanuel of Evercore, thank you very much. Equity futures on the S&P 500 positive here by 2 full percentage points on the S&P. In the bond market, Treasuries set up as follows. Yields lower by 9 or 10 basis points. Some stability in this bond market, your 30-year 478. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Hacker. Say, Yahara.
Hi, John. President Trump says he never had any intention of firing Federal Reserve Chair Jerome Powell. His comments come just days after the president posted on social media, quote, Powell's termination cannot come fast enough. And his National Economic Council director said Trump was exploring whether he had the authority to remove the Fed chair. Meanwhile, President Trump said he plans to be, quote, very nice to China in trade talks. Trump said the 145% duties he placed on the country will be dropped if the two countries can reach a deal. China has been intensifying its outreach to other countries in recent weeks, warning them not to strike trade deals with the U.S. that hurt Beijing's interests. And tech giants Apple and Meta have been fined nearly $800 million by the European Union for violating antitrust rules under the EU Digital Markets Act, with Apple taking the brunt of the punishment. The fines are far lower than previous penalties and are seen as an attempt to avoid provoking a harsh response from President Trump. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, playing nice with China.
Mr. President, on China, your press secretary has suggested that some progress is being made. Are negotiations actively underway?
We're doing fine with China. We're going to be very nice. They're going to be very nice, and we'll see what happens.
It's a change of tone. Adam Posen of the Peterson Institute joins us next. Then we'll get a final word from Julian Emanuel of Evercore. Live from New York City this morning. Good morning.
going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
The gains continue. The president saying all the right things yesterday for financial markets. Equity futures up by 2% on the S&P, on the Nasdaq up by 2.5%. Elon Musk doing the same thing over at Tesla. Tesla in the pre-market higher by around 6% this morning. This from Dan Ives of Wedbush. Tesla gets back Musk. That name up by 6.3%. Under surveillance this morning, playing nice with China.
Mr. President, on China, your press secretary has suggested that some progress is being made. Are negotiations actively underway?
We're doing fine with China. We're going to be very nice. They're going to be very nice. And we'll see what happens. But ultimately, they have to make a deal. 145% is very high, and it won't be that high. I think we'll make a deal with China.
So here's the latest this morning. President Trump saying tariffs on China will come down, quote, substantially, just after Treasury Secretary Scott Bessent said the standoff was unsustainable. Joining us now from the nation's capital, Lisa joins us for more at the IMF World Bank spring meetings. Hey, Lisa.
Hey, John. Yeah, I'm here at a time when people are wondering the relevance of some of these large trade organizations, given the fact that the global world order is getting questioned. I'm here with Adam Posen, who is the president of the Peterson Institute, one of the last bastions celebrating free trade. And I want to start there with this idea of China and some of the conciliatory language that we heard from the president yesterday. Do you have a greater level of conviction that we actually are going to see some sort of ratcheting down of the tensions and a bringing of tariffs down to a level that actually could still facilitate some modicum of free trade?
In a word, no, Lisa, I'm sad to say, because three things. First, China at this point doesn't want to have a deal with the U.S. I mean, ultimately, they want to have a deal, but they're not just going to show up because one day Trump rolls out of bed and says more conciliatory things, or one day the Treasury Secretary admits reality that this is self-destructive. The second thing that's going on is just in reality, trade deals take a lot to happen. They actually require people to do work. And this is why the Chinese government has been very clear that they want somebody appointed from the Trump administration with a staff that can actually work with their Chinese counterparts. I'm not trying to make the Chinese to be heroes here. It's just they're being grown-ups. They're not going to engage in this unless there's real staff. And we don't have an undersecretary of the Treasury. We don't have an assistant secretary of the Treasury. We don't have most of the deputy USTRs. There's no one to do this work, especially since they're busy killing the civil service, who would be the people who could do it. But the third most important thing, Lisa, is the basis for a deal only makes sense if there's agreement more broadly with U.S. allies. This is what the Trump people get sort of right and then get wrong, because otherwise you get other deals China makes, overflow of Chinese exports to other countries, leakage of what both Biden and Trump consider Chinese goods coming into the U.S., uneven standards. It only makes sense, and this is why we have an international world order that the Trump people are ignoring, because bilateral deals don't do the job.
You talk about the international world order, and if there's any time that kind of represents that, it is this one, because This is the week of the World Bank and the International Monetary Fund coming together and global leaders. Has it ever been less relevant?
It's never been, or at least not in decades, been this much of a side game. It remains relevant, but the way to think about it, which is also true of the WTO, is it has a lot of capacity to do good. And for the developing world, the smaller economies, the poorer economies, who actually have their lives improved directly by the advice, the actions, the rules checking of these international organizations like the IMF, the World Bank, the WTO, it matters hugely, and particularly for countries who have debts to the IMF. That is still an ongoing issue. But ultimately, it's like the president ignores Congress. If Congress doesn't stand up, there's nothing you can do about it. If the U.S. and China and the rest of the world don't put their faith in, don't make use of the IMF, the WTO, the World Bank, then they just sit on the sidelines. So they'll be relevant again when the rest of the world wakes up.
Do you think that there is a fear that in order for the IMF to preserve the U.S.'s relationship with them, they will cater overwhelmingly to them, as evidenced by, say, Argentina and catering to Malay in a way because of his maybe alliance with President Trump? That is one speculation out there. Is that something that makes some countries concerned about doing business with the IMF?
I think that's an entirely fair question to raise. It's a real criticism. It's a real concern, Lisa. And it's been inherent since the start. So a couple of years ago, I wrote an article about the post-American world economy and foreign affairs. And what I talked about was the idea that the U.S. was chair of the club. And this meant that in the IMF, in all these organizations, U.S. had way beyond its size power over who got to be a member and self-dealing. You know, we like Argentina, we don't like Venezuela, IMF help Argentina, don't help Venezuela. But the point was, when you're chair of the club, you don't overdo it, because then everyone says, why am I in the club if you're ripping me off? And that's the point we've gotten to. So the U.S. has to recognize either if it overdoes things, no one's going to want to play ball with them, and it goes away. And so they have to scale it back, or the rest of the world gets on with it. The world's a worse place, but they start doing things without the U.S. And that's the way to see it, whether it's Argentina or debt deals vis-a-vis Pakistan or Egypt. That's the way to see it. The U.S. should have a hand, but if they've overplayed it and they're disregarding the limits to their hand.
Every year, it seems like there's an elephant in the room at the different IMF meetings. First, it was this question of the tensions between China and the U.S. Then it was the potential election of President Trump. This year, yesterday, for a hot second, it was the independence of the Federal Reserve and whether that could torpedo the financial system. Has that question been resolved, since it was just the media overplaying things and there's no intention by the White House to fire Fed Chair Powell?
That's completely false. I mean, they can say that, but the idea that the President of the United States went beyond the normal jawboning of the Fed, I don't like this policy, to we should terminate this person, is beyond crazy. And the idea that the President of the United States being advised by senior officials, hey, look what's happening to markets, according to news reports, had to have another aide distracted out the other wing of the White House to finally say, okay, maybe I should do something about this and calm markets down. So, you know, you and I were talking, is this parking the issue? It's 60-minute parking. Everyone's going to be aware that you can't leave it overnight where it is. As long as this president is disrespecting the institutions of our economy and trying to exercise excessive executive power, there is that sense of risk. And we're seeing this in the trade field. We're seeing this with respect to Fed independence. We're seeing this with respect to the federal workforce. And we're starting to see it with the federal budget. And so it's a systemic issue that if you overdo executive discretion, the markets, all the millions of people making decisions economically and investing react. And the president only gets out of this if he, in a credible way, commits to self-limit.
Adam Posen, thank you so much for being with us. That's Adam Posen of the Peterson Institute. And John, for people looking for a sense of optimism this morning that you felt in markets briefly, that sort of dampened that pretty dramatically.
We've got that optimism around the table with us here in New York. Lisa, thank you. Down in Washington, D.C., more from Lisa later on this morning. In about an hour from now, sitting down with the Bundesbank president, the leader of the German central bank. So look out for that. Julian Emanuel is that optimist. He joined us from Evercore. He's still with us. Julian, the optimism for the United States, I think, is a really important conversation now, because what we hear elsewhere is optimism for elsewhere. We see that from Janice Henderson, from Amundi, talking about a rebalancing to the international story. Are things much better abroad right now?
No, they're not much better, okay? What it is that, and look, we have to be sort of upfront about this. A Trump administration, we knew this, was going to mean a higher volatility asset market, a higher volatility societal existence. That's what we have. But when you think about the rest of the world, look, the fact is, and this is contrary to the expectation of most academicians, is that a tariff regime has actually caused a peak in the U.S. dollar. And we think it's a pretty significant peak. And if you think about how people have been investing in the rest of the world, the biggest concern that you have is how am I going to be impacted in terms of currency? So when you think about the differentials in valuation that have accrued over the last 10 years, it's natural. It's not, this incredible $1 out of U.S. means $1 into the rest of the world. If you look at the last time that the rest of the world outperformed the U.S., it was in the early 00s. All the boats floated. The U.S. was still up 100%, even though it underperformed. And we think that's where the investment landscape is headed.
Julian, it's good to see you, as always. Thanks for dropping by. Julian Emmanuel there of Evercore. Speaking of volatility in foreign exchange, euro-dollar on Monday came close to 116, 115.73. This morning, it's got a 113 handle. It's a break of 114 at 113.99. Up next on the program, we'll catch up with Ben Callow of Baird on Tesla's disappointing first quarter results and a recommitment from Elon Musk to the company. That conversation up next.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good, but as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Session highs on the S&P 500, higher by 2.3% on the S&P. This from Evercore and Julian Emmanuel just moments ago. Our base case is that the lows of this sell-off have been seen. Elsewhere, the Nasdaq 100 higher by 2.7 on the Russell 2000 up by 2.2. It's a decent rally 3 hours away from the opening bell with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. And within that decent rally, one of the stocks at the top of the pile is Tesla this morning, up 6.5% pre-market. Forget the fact that they missed on earnings, that they missed on operating income, that they declined to give a growth forecast for 2025. It is Elon Musk refocusing his attention back to Tesla and away from Doge. That was enough to reawaken the bulls. Dan Ives of Wedbush just moments ago upgrading his price target for the stock, calling it a change coming for this company and a new chapter. Meanwhile, Intel, that's also higher in the pre-market session, up by 4.6%, a really fantastic scoop from the Bloomberg tech team that Intel will lay off about 20% of its workforce. It plans to announce that job cut this week at some point. All of an effort from the new CEO to try to remove some of the bureaucratic layers of Intel. At the same time, a person familiar telling Bloomberg that they want to refocus the company into an engineer-driven culture. So that's the rally in those shares. Finally, rounding things off with Meta, to be clear, all the Mag 7 is gaining a lot this morning off the back of that relief rally. Meta, no exception, up 4%. But taking a leg higher over the past hour on some breaking news that the EU plans to fine Meta and Apple some 700 million euros. Now, it might be counterintuitive that Meta would be rallying on what for them will be a 200 million euro fine. That's actually a much lower amount than the EU usually imposes over these kinds of competition issues, perhaps a way for them to both fine them and try to avoid provoking President Donald Trump. John.
Not even a scratch. Danny, thank you. Meta higher by 4% in the pre-market. On our radar this morning, our top story, President Trump diffusing market concerns over trade tensions and Fed independence, signaling he'll cut tariffs on China if the countries can reach a deal, and saying he has no intention of firing the Fed chair, Jay Powell.
Soothing words from the Oval Office, and what a relief we are seeing now in equity markets on two fronts. The president backing away from really bombastic rhetoric when it came to Jay Powell. He left lingering for days what he meant by that phrase termination, end of a term, or looking to oust him. He said the press ran away with it. Not so sure when you have Kevin Hassett saying they're looking into potential new legal options. But for now, the president is putting that to bed and saying, I have no intention, never had intention of firing him. I just wanted to cut rates. And then on China, the president is saying we're going to be, quote, very nice. And what he's talking about is there's going to be a range. It's not going to be 0%, but it's not going to be 145%. Go back to what the president said on the campaign trail. 60% tariffs on China, 10% around the United States. And Jonathan, that's almost what we're shaping up to potentially look like at the end of the day.
The last 24 hours is a classic example as to why so many people were super bearish but weren't short, because they were worried about these kind of headlines that would deliver this kind of relief rally. Now, if you get moves like this off the headlines we've seen in the last 24 hours, what happens when he does just turn around and say, guess what? The new policy is just a baseline 10% tariff. We've got these amazing deals with Europe, with China, with India, Brazil, and elsewhere.
The market has seen the worst, and they're willing to digest that 10%. But imagine going from 0 to 10%. No, it's much better to go from 26% on India, 30-something% on the European Union, down to 10%. So the president, what the administration would say at this moment, is doing the art of the deal. And the press, for a while, they say miss it. Not so sure about that. Here's the issue. Julian Emmanuel is saying, maybe, you know what, the lows are already baked in and we're done. We're off to the races. What happens when it's not Besant Ascent, as Neil Dutta would put it, and someone like Peter Navarro is back in the middle getting the president's ear?
That's how things are this morning. Things can change tomorrow. And this is why so many asset managers are considering doing this. Janice Henderson seeing cracks in so-called U.S. exceptionalism. The asset manager weighing a 10% reduction in exposure to U.S. assets and reallocation to places like Europe, China, the Middle East, and Latin America. Investors grappling with the same policy volatility we've been talking about over the past few weeks.
That sell America sentiment is still alive, and you could see that in the flow. The flow data provided by Morningstar Direct shows general flight from U.S. funds this month. What I found interesting is the research analyst came out and said this. They're seeing some patriotic rebalancing of capital of Europe. So if you're domiciled in Germany or France, you're looking at maybe out of a patriotic level, looking at putting funds back in your own economies. I think it's more the President of the United States is forcing Europe to do things that they've been dragging their feet to do.
It's difficult to bet against the U.S. consumer. Earlier on in the program, I joked about what was happening with retail sales, that people were going out and buying cars even though they were worried about the economy.
I know them.
What are they worried about, though? Are they worried about losing their job? or are they worried about higher prices? Because if you're worried about losing your job, you don't go out and buy a car. Are you worried about higher prices? Then maybe you front load some purchases. And I think that's what we've seen in retail sales more recently.
That's a great question. Anecdotally, from personal experience, what I've heard from people, AKA people in my family, they are going out and getting the purchases that they think the prices are going to go up. My sister is going out and buying a brand new car. She is also stockpiling Legos for Christmas for the kids. My mother and my dad are buying new laptops and desktops because they're nervous that the Apple prices are going to go up. That's what they're doing. They just don't want to pay the higher cost in 6 months' time. They're not nervous about the economy fully tanking.
They're nervous about prices going up, not losing their job. That's a big issue and an important distinction. Equity futures on the S&P 500 at the moment, higher. Session highs up by 2.3%. Tesla also rising despite missing first quarter earnings expectations as the CEO, Elon Musk, promises to pull back from his Doge work next month. The EV maker warning tariffs will impact his profitability, and Musk saying he's pushed for lower levies. Sticking with that name, Ben Callow of Baird lowering his price target on the stock to $320 while maintaining an outperform rating, noting the challenging backdrop and near-term downside bias. Ben joins us now for more. Ben, welcome to the program, sir. We've got the results, and then we've got the call and the elephant in the room. So let's deal with the elephant in the room on the call. How encouraging is it to you that Elon Musk will step back in the coming weeks and lean into things like Tesla again?
Let's start. Thanks for having me on. I do worry that it's a little bit too late. I thought that on the call, one of the disappointing things was how they answered the question around brand damage. And I thought it was a pretty weak answer. They did talk about how they gave more test drives in Q1 than ever before. They set a record there. But I don't think they addressed that question good enough. I think that question does linger on. So in the short term, that's why we're biased to the downside. Even with some catalysts coming up with the lower price vehicle, as well as the robo-taxi starting in Austin.
Ben, how much brand damage has actually been done? How do you gauge that? And what could they have said on the call that could have addressed it?
I think it's too early to tell. I think that Elon started with talking about how the protests were organized and the protesters were paid. I thought that was a little glib in my view, and I don't know because they shut down the 4 factories as they refreshed the Model Y. I don't know if we've seen brand damage versus the production ramp up that impacted Q1, and so really Q2 I think is going to be the telling point when we see the total deliveries there as well. There'll still be some production ramp from the Model Y that will affect that. But I do think that there is, at least at the fringe, there has been brand damage in Europe and in the United States.
How does Elon Musk fix that? If leaving Doge is the first step, what does he need to do?
I think the engagement last night was a marathon of a call for Tesla. It was about 90 minutes long. He doesn't usually spend that much time with investors and analysts out there. I think that was a first step. I think doing that with employees. One of the things that we've always liked about Tesla is its ability to attract the best engineers, the best talent from all different types of industries. And in addition to brand damage on selling vehicles, I think brand damage on being able to attract and retain employees is also a question mark. So I think him re-engaging with Tesla on a full-time basis, stop being in the public eye so much, even though he expressed that it's something big that he feels compelled to do with the government, but to take a more of a backseat role there, more of a front seat role at Tesla.
Are you seeing any positives from Elon Musk's relationship with the president? I know yesterday he said the president has a right to do what he wants on tariffs and he can voice his opinion, but at the moment, is Elon Musk's opinion going very far when it comes to trade?
It's unclear right now, and also on the energy section of the business too, which has been really carrying the business. They had record margin there, but they did pull guidance from the volumes because of tariffs on it. There is also the Inflation Reduction Act that's likely to come up to vote in some way, whether it's extended some of the tax credits or they're taken away. That wasn't asked on the call, but it does impact their business. So we have yet to see actual benefits. The one place I would say is on the autonomy side, where the president's pushed for fast-tracking autonomy across the United States from a government perspective.
Ben, let's talk about that issue. When you speak to a lot of bulls on Tesla, they won't talk about traditional autos. They won't even talk about EVs. They'll talk about things like rubber taxis. They'll talk about full self-driving. They'll talk about the future, the story, really, that's driven this name over the past few years. Ben, where do you sit on some of those issues now?
So I'd put three different categories there. I'd put the cyber cab / robo-taxi, number one, Optimus, the robot, humanoid robot, and then three, Dojo, their own chip, to compete with NVIDIA. I feel more optimistic about Optimus, the robot. I do think that the robo-taxi business is going to be more competitive than we think. You have Waymo out there. You have many others out there. I do think that when you get down to it, the myth becomes a reality, and then you're going to start having to service these vehicles, clean the vehicles, but until it becomes a reality in June, it starts in a small way in Austin. I think that that catalyst drives the stock higher in anticipation of them rolling that out. I do think that it's interesting that with the poor results, even though I think they were expected, so there's a little bit of relief rally in the overall rally in the market, that Elon keeps getting this longer leash for timelines. So you kind of pushed out Optimus because of tariffs and the inability to get magnets for the robots. So some of the numbers kind of moved into next year. And then on robotaxi, he talked about it not really impacting the financials until mid next year. But then throughout this, millions of robotaxis on the road in the second half, which is a very big number. And so that still gets excitement when he says things like that. And, I've covered the stock for, over a decade. And Elon has been right, always, a couple of years early, 2 years early or so. And so I think that we're still in that phase where Elon's getting that leash, getting, the credit, and the people are believing in him. But I don't know how long that lasts.
Hey, Ben, appreciate your take this morning. Thank you, sir. Ben Callow there of Baird. The stock is higher by 6.5%. It's a feature of the rally we're seeing this morning. The president backing away on certain issues, equities up, and seemingly, to some extent, to some degree, Elon Musk backing away from Doge and leaning into Tesla all over again.
And this is exactly what bulls like Dan Ives have been calling for. Dan Ives yesterday saying this is a code red. This morning he's saying it's a new chapter in the Tesla story. Basically, Elon Musk saying he's going to dip in and out, maybe 1 or 2 days. He's going to also obviously consult with the president, but he has his team in place, and he's going to walk away from Doge next month, which is next week.
That's the question for Dan Ives. Still 1 or 2 days a week. Still 1 or 2 days a week with Doge. And if you believe that that is leading to some brand damage, then it's still 1 to 2 days a week with Doge that could lead to more brand damage.
And what did Ed Ludlow say yesterday? What he is hearing from some people is that Elon Musk's attention might not go full throttle into Tesla. He has a number of other companies like XAI and X that he's looking at as well.
Dan Ives of Wedbush, still bullish on the name. He'll join us later this morning, 8:15 Eastern time. A few hours away, so look out for that. More broadly, session highs in the equity market on the S&P 500 up nicely by 2.3% with an update on stories elsewhere. With your Bloomberg Brief, here's Yahara Heckes. Hey, Yahara.
Hi, John. IMF Managing Director Kristalina Georgieva weighed in on President Trump's criticism of Fed Chair Jay Powell. She spoke with Lisa Abramowicz at the IMF meeting in Washington, D.C.
They have one instrument that I want to emphasize, which is credibility. And credibility comes with independence. So if we want the comfort that when the next financial stress comes, then the Fed can act decisively. This particular instrument, credibility, is really very valuable to protect.
Coming up at 7:30 a.m., Lisa will be speaking with the Bundesbank President, Joachim Nagel. Meanwhile, shares of SAP are rising in German, trading up 10%, with Europe's most valuable company reporting first quarter earnings that handily topped analyst estimates. The software company's strong profit was fueled by its pivot to cloud services. And another stock to watch is Intel. Those shares are rising 4.4% in the pre-market. The company is expected to announce plans to cut more than 20% of its staff this week. A source says the move is part of a bid by the new CEO to streamline management, eliminate bureaucracy, and rebuild an engineering-driven culture at the struggling chip maker. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on in the next hour. Up next on the program, the president backing off Powell.
No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates. If he doesn't, is it the end? No, it's not, but it would be good timing.
Those words unlock a little bit of dollar strength. That conversation up next with Kit Jukes of SocGen. Live from New York, you're watching Bloomberg TV.
Incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The president saying all the right things, unlocking some gains on Wall Street. Equity futures up by 2.5% on the S&P, on the Nasdaq up by 2.9% in the bond market, helping out the long end of the curve. Look at this. Yields down by 11 basis points on 30s, down 8 on 10s. Your 10-year 432.27. Under surveillance this morning, the president backing off Fed Chair Jay Powell.
No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates. This is a perfect time to lower interest rates. If he doesn't, is it the end? No, it's not. But it would be good timing. It could have taken place earlier. But no, I have no intention to fire him.
So here's the latest this morning. Dollar weakness easing as President Trump strikes a conciliatory tone after expressing frustration with Fed Chair Jay Powell. Kit Jukes of SocGen writing, less Fed independence equals a weaker dollar. Even if we assume the president can't or won't fire the Fed chair, the makeup of the FOMC can change over time. Kit joins us now for more. Kit, welcome to the program, sir. Do those words do enough to repair the damage done?
They do enough to stop the move we've had and calm things down. You know, it looked stretched. But no, I think that the heart of the issue is that the rest of the world is dramatically